everybody. My name is Evert Castelein. I'm the lead fund manager of Aberdeen Standard European Logistics Income PLC, an investment trust that listed on the London Stock Exchange since it launched in December 2017. I'm based in Utrecht, the Netherlands, from where I run the fund. Today I would like to give you an idea of the strategy that we are managing and give you an idea of how the market has behaved in the last few months and what the portfolio looks like today. It's all summarized in slide number 2. Why ASLI? Why do we think this is a really interesting investment opportunity? Well, there are a couple of reasons for that, and the key points are listed in this table. I think, as said by Richard, logistics really is one of the strongest performing sectors out there. It has outperformed the retail and office sectors in the last few years, and our house view predicts and forecasts that will remain the case going forward. And there are a couple of reasons for that. There are very strong drivers on the demand side. The rise of e-commerce really has accelerated thanks to COVID-19, but also the fact that logistic operators are making the supply chain more resilient, which means higher inventory levels and the reshoring of manufacturing activities back to Europe. So on demand, it's really strong, and at the same time, there's hardly any space available. The supply side is very tight. So on aggregate, we're looking at 4% vacancy across Europe. So that's a very important characteristic of logistics. With the strategy itself, we're investing in the most liquid part of the market, which is the big box and the mid-sized assets within the big box range, and urban logistics. To start with the first one, we're buying assets with typical lot sizes of around 500,000 square meters, assets where we think we have that have a second life in terms of lettability, future lettability. If the tenant leaves, then we want to have an alternative to lease it out again. And urban logistics. Urban logistics is a part of the market that has grown rapidly. There's a lot of focus on that, and that can easily be explained by the fact that e-commerce sales have really accelerated, and that means that logistic operators are trying to find locations close to large population centers in order to reduce delivery times of the products that are ordered online. So that's the focus that we have. This is a European strategy that I'm managing, but we've always said from the outset that even though we see ourselves as stock pickers, we have a top-down view of markets, and we'd rather not invest in UK. There are a couple of reasons for that. Even though this fund is listed on the London Stock Exchange, we saw that there was already a lot of competition in the UK. But more importantly, we felt that the UK was more advanced in the property cycle with prime yields close to 4% against the continent where yields were closer to 5%. So we felt there was better value on the continent. So that's the first reason. The second reason is that a typical standard lease agreement on the continent has full CPI indexation every year, so providing the investors with an inflation hedge. That's not the case in the UK, where normally rents remain flat for the remainder of the lease. And there's a third reason, and that is that financing costs on a continent are way, way lower than in the UK. Most recent loan transaction that I've signed was costing 94 bips on a 7-year fixed term. So these are the reasons why we have built up a portfolio on the continent with the local teams. That's really one of the unique selling points of Aberdeen Standard Investments. We are the second largest real estate investor in Europe. We have almost 40 billion of assets under management. And that means we have local offices across Europe. And the property business is a local business. So you need to have access to markets, speak the local language, know the brokers, the project developers, the banks, the owner occupiers, in order to find the right deals. And once you have bought an asset, also keep it in good shape. So we have transaction and asset managers taking care of business locally, and that's really, really important. And that's how we have built up a really good working relationship with many developers across Europe. 8 out of the 14 buildings that we have in portfolio are brand new, 0.5, which means that it ticks all the boxes of the modern specifications required nowadays by logistic operators. So the average lease length of 9.5 years means that with the new buildings that we have in portfolio, that we have a very long and durable income stream and fully indexed income stream. So I think we're in a very good position to deliver now that we are fully invested. But that doesn't mean that now we're fully invested that we're sitting on our hands. No, with these local resources, we try to add value where we can through active asset management. Point 6, through building extensions where we have land available and where the tenant needs additional warehouse space, we can provide that and take a development profit out of these projects. But we're also looking to improve our green performance and reduce our carbon footprint by putting solar panels on our roofs. And that can be very profitable. We've done that in France on the roof, where we just signed a roof lease with the solar panel specialist and collected 160,000 euro per annum additional rent. So that's how we work on a portfolio. Gearing target is modest. We're aiming for 35%. At the moment, we're at 34%. We would like to keep it below 40%, even though we could go up to 50%. We were told by our investors that they would like us to keep it below 40% because we all have in the back of our minds what happened during the global financial crisis when banks stepped in. So we don't want to go there. So we have taken a very modest approach. For management fee, all-in fee for the investors, 75 bips on any fee, which is low compared to what our competitors are charging. There are no hidden costs. There are no performance fees. This is the cost for you as an investor. And as said, point 9, we're fully invested. Dividends is almost entirely covered. And we're looking to raise more capital and grow the fund further by diversifying in new assets and new markets. So that's in a nutshell who we are, what we are doing, and what the plans are for the future. The agenda, just being cautious of time, I'll just skip. Just a few words on the market, slide number 5. So what has been the impact of COVID-19? Has it had a negative or a positive impact? In the short term, of course, there will be a negative impact because some companies will struggle and maybe some even won't survive the recession we're in at the moment. But we also have seen and also recognized in my own portfolio that some sectors have struggled more than others. The impact of the lockdown, the partial lockdown in Europe in order to flatten the curve has impacted especially companies focusing on international trade, but also discretionary spending, for example, in the automotive industry or high street fashion. But at the same time, we have seen companies that have really benefited from the COVID-19. And I'm thinking about groceries, pharmaceutical companies, the packaging industry, and everything that's linked to e-commerce, because e-commerce has really accelerated. We think that where we are today is where we would normally have been 5 years from now, because you probably recognize in your own consumption behavior, we've all consumed much more online, and more people have started to do that. So also older generations have started to buy online. And as always, Amazon is of course the best example to follow. And they've recently announced that they're recruiting 100,000 additional staff, and they're expanding their warehouse stock with the 20%. So that has really helped the demand side of logistics. It's fair to say that you don't need to have e-commerce retailers in your portfolio to benefit from the growth, because the sector as a whole is expanding. And as I explained in the outset, there's hardly any stock available. So if you have an asset without e-commerce retailer, you can also benefit from the market rental growth because of the scarcity and the lack of supply. If we look at the mid and long term, we think that trend of e-commerce and growth is structural, not cyclical. But we also recognize that supply chains were maybe too much focused on just-in-time deliveries, too efficient. Building inventory levels was seen as not such a wise strategy because that comes with a cost. But now the perception has completely changed because supply chains, as we have all seen, have been disrupted quite severely by the lockdown. And that means that supply chains probably need to be more resilient to shocks, and therefore manufacturers are building inventory levels to absorb these shocks. If you take a car, The car exists out of 30,000 parts. They need to come from all over the world. If one part is missing, you can't finish the car. So then it may be better to have some of the essential parts of the car stored closer to home. So there's a sort of deglobalization going on, and also a reshoring of manufacturing activities from Asia to Europe. So I think the sector is in a really good position. That's also reflected in our house view, slide 6, where we show the total return forecast per sector on the left-hand side and per country on the right-hand side. To start with the sector overview, you can clearly see that on the left-hand side, the residential and the logistics sectors are expected to outperform the retail sector, clearly struggling with the lockdown and with a lot of shops being closed. Although across Europe, many of these shops have reopened, but investors are quite uncertain about the future of retail. Are we going back to brick and mortar shops, or are we going to buy more online like we've done in the last few weeks? And offices, now that we're used to working from home, you can ask yourself, do we need that much office space in the future? So logistics and residential are really the preferred sectors. And for the next 3 years, we expect a property level total return, so that's income return plus capital growth of 6.6. That's before leverage. If you move to the right, if you look at the countries across Europe, so what are our expectations? Well, in the absolute core markets, that's where we at the moment heavily invest in Netherlands, France, and Germany. We have higher expectations than if you go more to the east and the south of Europe, where economies are more struggling. The income component in the absolute core markets is lower because yields are lower. But at the same time, we think there will be a focus of investors on quality, a flight to quality, and therefore a higher capital growth expectation in absolute core markets. We've also invested in higher yielding countries such as Poland, where you get a premium on yield. So for us, that can also be a very interesting country to offset some of the very keen yields in the western part of Europe. I've also listed here the UK to, again, make the point clear why we haven't invested in the UK. We think yields are very keen. Typically, there's no full indexation of the rents. And we think this is before leverage. So even if you include leverage, the UK would be seen as a less attractive market because financing costs are just so high. So that's on our expectation. If we move on, slide 8, our portfolio. So where have we invested the capital that we have raised? The majority of it has been invested in the Netherlands, almost 50%, 6 assets. And that's not because I'm based in the Netherlands and have a home bias. No, that's because even though the Netherlands is a small country, it's really big in logistics. It's seen as the gateway to the West European market, with the largest port in Europe, which is the port of Rotterdam, and the proximity of the German hinterland. So that makes the Netherlands as a country very, very attractive. But we've also invested in France, 2 assets in Germany, 2 assets in Poland, and 2 assets in Spain. 14 assets, 5 countries, no vacancy, long average lease length, a WALT of around 9 years, and a tenant base that's really stable. So we haven't had any bankruptcies in the first half of the year. There were a couple of tenants that have asked for rent deferrals, which we have granted. Deferral means that you have to pay rent in a later stage. So these sort of discussions took place, especially in Q2. And we had a couple of discussions with smaller tenants in our multi-tenant buildings, where a request came for a rent reduction, which we tried to stay away from, and where we moved the discussion towards a rent-free now in exchange of a material lease extension. So on a net basis, if you look at the future cash flow projection, there's hardly any impact from COVID-19 as per today. And it has also led to the decision to pay out the full Q1 dividend. So with the quality that we have in portfolio, I think we're in a very good position to deliver going forward. And the sort of quality is reflected on page 9, which is the most recent addition to the portfolio in Den Hoorn. It's a building that has been erected in January this year, 10-year lease to a strong covenant tenant. Den Hoorn is a place between the cities of The Hague and Rotterdam, which is the most densely populated area in the Netherlands. So it has a very strong urban profile, and it's located alongside the main motorway between these cities. So it's very well accessible, and for that reason you also find last mile delivery specialists such as DHL and PostNL on the exact same location. So these are the sort of assets that I really like, where we think we will be able to generate a durable income stream. Even though we have a strong covenant tenant, if they leave, there is an alternative. The asset is not very bespoke. It's an average size, so it's not, sometimes you see these ultra big boxes with sizes of above 1 million square feet. Well, if the tenant leaves in such a building or gives you a hard time at the end of the lease, then probably you don't have very strong negotiation power, because the number of tenants that can take that space is limited. Here we have an alternative. The building is flexible. You can easily split it in 2 parts with a separation wall, and there are office blocks on each corner, as you can see. You may think, well, a new building, you can't add a lot of value. That's not true. We plan to put solar panels on top of the roof by signing a roof lease with a solar panel specialist. The picture at the bottom is from our Avignon assets, so that's what we try to achieve on all our assets. Another good example of an asset is on slide 10 in Madrid, property leased out to DHL. As you can see on the small map at the bottom right-hand side highlighted in red. It's within walking distance from the airport, and it's within biking distance from the city center. That's where you want to be if you're a specialist in the last touch or the last mile deliveries, because these operators like DHL, they want to compete on delivery times. They want to deliver your goods ordered online within 24 hours. So that's where you want to be. And we have really high growth expectations for this really scarce last mile hubs. So that's a good reflection, I think, of our strategy. Just a few more words on slide 11 on the rent collection, because that's of course one of the main risks to focus on. Are we able to collect rent with the portfolio that we have? And the answer is yes. We have collected 100% for Q1 rent. We expect to raise or collect at least 82% of the Q2 rent. And the remainder is deferred to the second half of this year, so, or forgiven in way of rent-free in combination with lease extension. So by the end of this year, we expect to have collected 95% of the Q2 rent. So that will put us in a really good position to keep paying out a healthy dividend. And I'm very positive that now that economies are reopening, that all the difficult discussions that we've had have now been completed, and that we can just move on with our lives. And yeah, based on the stories I hear from my tenants, is that I see that turnovers are picking up again. So they're in a good position, we hope, I think, in the course of this year to pay the deferred rent as well. Asset management ESG, slide 13. I've listed a couple of examples of activities and where we focus on. First 4 examples are projects we're currently working on where we think we can add value in the course of this or next year. Focuses very much on ESG, so we try to reduce the carbon footprint and also generate additional income streams by putting solar panels on roofs. So Den Hoorn, the asset I just presented, it's also on the front page, will have solar panels probably in the course of this year. And the same applies to Ede and Zeewolde. And there's also an option in portfolio in Management, which is just south of Paris, a very important logistic hub, where the building only covers 29% of the piece of land it's on. Normally it's 50%, so there's ample space available, and the tenant has asked us if we can extend the building because they need extra space. So that's how we work on a portfolio. There are a couple of other examples like that, but here, so number 5 till 9, but here we are more depending on the request from tenants if they need additional space. Just on ESG, a few words. Slide 14. As always, when it comes down to ESG, a lot of warm words and window dressing. As a fund manager, I'm just trying to keep it real. What does it mean to my investors? Okay, what can we do and keep it very pragmatic? Well, fact is that with the 8 new buildings that we have in portfolio, is that we are already in a very good starting position. We have LED lighting in all our buildings. We have solar panels on 6 buildings. We're going to add 2 projects in the course of this year. We're working on smaller initiatives like green travel, and we're trying to measure our green performance by participating in GRESB, which is the Global Real Estate Sustainability Benchmark, where we have earned 2 green stars a year ago based on 4 assets we had in portfolio at the time. Now that we're fully invested, I think we have a better representation in this year's survey. And we try to improve by engaging with the tenants on data collection. We try to put smart meters in place so we can daily monitor energy consumption. We're doing like sustainability audits on our buildings to see how we can improve things going forward. We're interviewing our tenants, that's the S, the social component in ESG, to see how we can work together in a better way and what they think of us and what they think of the building. So there are a lot of initiatives that we undertake with our local resources, the asset managers, to see how we can improve our portfolio. Just to finalize, a few words on the financial highlights. So where are we with the fund? In June, we sent out a press release stating that the NAV per share was 112.7 cents. That's an uplift of 2.7 cents over the quarter. 1.4 cents was dividend related, and the remainder was related to capital growth. We have experienced some capital growth in Q1. The total return on NAV was 2.8% in the first quarter, and the key driver set behind that was capital appreciation for standing investments. That's still excluding the Den Hoorn deal that I've shown. Den Hoorn was closed in January and immediately experienced a 4.2% capital uplift when it was added to the portfolio, and we bought that asset in autumn 2019. So that was a really positive result, and just shows that we have bought an asset that's highly sought after by investors. Gearing 34.4% on total portfolio. That's exactly where we want to be. At the moment, the target is 35. We're looking to increase the gearing potentially on a temporary basis going forward with a revolving credit facility, which we would like to use to buy an asset first and then go back to the market for a new capital raise, which would then reduce the cash drag. Instead of raising capital and then trying to find the asset, we think it's better to buy the asset first and then make an immediate down payment on that facility, assuming that we successfully raise capital. Total portfolio size 404 million. We're looking to grow that to a size of 1 billion in the next 3 years, so we're quite ambitious. Dividend yield is around 5% normally, just depending on where the share price is. And yeah, the dividend policy is that we pay out 5% distribution per annum, and we have a total return target of 7.5%. I think the next slide gives you a little bit more insight in the waterfall and the reconciliation between Q4 and Q1. I think this is in a nutshell what I would like to say. So you probably see that I'm excited, positive. My glass is more than half full. We're in a really good position with the strategy that we have. We're focusing on mid-box, the very liquid part of the big box segment. We're focusing on urban logistics, sort of assets that are highly sought after by e-commerce specialists. We have local resources, and we see a lot of interesting deals at the moment with our transaction managers. And yeah, we'd like to diversify our portfolio further into new markets together with investors. And yeah, hopefully you like the strategy and the proposition. Thank you.
Cool. Okay. Thanks, Evert. Let's see what questions we have. First one here. Have you noticed a surge in inbound inquiries for space?
Sorry, I completely missed your question. Sorry, can you repeat, please?
Have you noticed a surge in inbound inquiries for space?
A surge. Yes, yes and no. I think initially a lot of the companies had a sort of wait and see attitude. Some of the decisions have been put on hold. But at the same time, we received quite a few requests from supermarkets that needed additional space, especially cold storage. We have quite a bit of cold storage in our portfolio. The Den Hoorn has, for example, has 50% of cold storage. And while the tenant was moving in, we received a request from a supermarket operator if they could use part of that cold storage on a temporary basis, because as you probably recognize, a lot of the people are getting their groceries in supermarkets and having lunch at home, so you don't go to a restaurant or a bar. So supermarkets are really benefiting from COVID-19 and therefore need additional warehouse space, especially cold storage. So yes, we have received these sort of requests, but I think if you look at the leasing market, many operators have had a sort of wait and see attitude just to get a bit of a feeling what's going on, how long the recession will last, how long the lockdown will take. But I think, yeah, momentum has picked up, and I think also the number of transactions will pick up as a consequence.
Cool. Next question from Mark Bentley. As European countries unlock, how are your non-food tenants trading? Are they now in a better place to pay rent on time?
If I just simply look at the discussions we have had around deferrals, there were actually two larger tenants that have asked for a deferral, and one of them was or is a European distribution center for giant bikes. It's a tenant in our Serenberg asset in the Netherlands. And as you may be aware, I mean, a lot of the bike shops were closed in March and April, and they simply couldn't deliver the bikes to the shop. So their turnover fell like a stone. And as a consequence, they came to us in Q2 saying, well, yeah, we don't make any turnover. Can we just defer rent to the second half of this year? And we fully understood why they were struggling. At the same time, they also had issues with getting the bikes from South Korea, where the giant bikes plant is, imported to the Netherlands. So we said, fine, we're willing to help you. We were just in a discussion to extend the building. And then, of course, that whole discussion was put on hold. So we helped them, and since then, bike sales have really gone through the roof. So in the last few months, a lot of people have started to buy bikes. I mean, if you can't go abroad for a holiday, and you have to stay at home, then yeah, what are you going to do? Make day trips and take a bike with you maybe. So last week when I spoke with that tenant, he explained to me that they don't see any issues with paying the rent in the second half of this year because of the spike in bike sales. And there are also some industrial operators like VSH Fittings, one of the larger tenants in our portfolio. They're simply working on their order book. They're specialized in production of sprinklers, valves, pipes, fittings, etc. So they don't have any issues either. So, and then there is one other discussion that we've had with Office Depot. That's our sixth largest tenant in portfolio among Soloir. They've also asked for a deferral, and actually the discussion has evolved in a positive way because this whole COVID-19 situation accelerated the decision to consolidate their business on our location. So they're going to close two warehouses in France and move to our building, which is very interesting. It's one of the examples I mentioned in the active asset management table, where we think we can add value because we already own the land. There's ample land available. So actually it's quite positive that this happened for Meung-sur-Loire, because we can now easily add value together with our tenant who's willing to sign a very long lease with us.
Cool. What would be the impact on NAV and dividends if inflation and interest rates were to increase substantially?
Well, the expectation is that we are entering into a market where we have to expect lower for longer. So the expectations are that, given the fact that we are in a recession, GDP growth is low or negative, that the inflation will remain low for a longer period of time, and interest rates as well. Even though we see that banks have increased liquidity premiums, on balance, the increase in financing costs has not really moved out that much, and a lot of the banks are positive on the fundamentals of the logistics sector. So they're quite keen on financing core logistics, maybe not so much value add and opportunistic strategies that typically use more gearing, or retail projects or office projects. So logistics also for banks is a very interesting opportunity. Yeah, it's difficult to predict what the future will bring. It also depends on if the virus will come back or not, and the length and the depth of the recession. I think we now have a better picture of how we can get the virus under control with maybe smaller lockdowns. But the impact on the NAV, and the total returns, we're quite positive, because logistics really, and core logistics in particular, it's just a very small niche, and investor sentiment is really positive towards the logistics sector. So it's really on top of the list. So if a lot of capital will move into a small market, then the only way yields can go is down and property values up. So actually, I wouldn't be surprised on the upside. It's already reflected in our house view that logistics is going to outperform the other sectors. In the 6.6 for the next 3 years per year. But I wouldn't be surprised on the upside for absolute core logistics, the sort of assets that we are buying.
Cool. Are there any geographies that you would avoid currently? Yeah,
well, I always say that even though we take a top-down view, I've explained why we haven't invested in the UK. We see ourselves as stock pickers. So I'd rather buy a very well-located asset with modern specification in a country that's maybe struggling, like Spain or Italy, than buy an obsolete asset on a standalone basis somewhere in Germany just for the sake of building exposure in the German market, which is the largest economy, of course, in Europe. So, but of course, we need to consider risk. That's what we can control as fund managers. So I bought 2 assets in Poland, a market that's seen as risky, especially on the supply side, because to be very selective on the sort of assets that you're buying. And for me, the location is always the most important thing to look at first. And the first question I always ask myself is, do I have an alternative? Does this asset have a second life? If it's well located and well accessible, and if the asset has modern specifications, so the eaves is plus 10 meters, the floor load bearing is 5 ton plus, at least 1 loading door per 1,000 square meter of floor space, then the answer is probably yes. And then we look into the covenant strength of tenants. Of course, that's very important because they need to be able to pay the rent, and the length of the lease, of course, is something we look into as well. But location, specifications of the asset, for me, that's absolutely key. And given my expectations where price will go, I wouldn't be surprised that we will move a little bit more towards Central and Eastern Europe, and maybe also to the southern part of Europe, where you get a small yield premium. Because yields in absolute core countries such as France, Germany, and Netherlands, and I recognize that in my own portfolio, these yields have come down very rapidly. So I'm not going to buy assets yielding 4%. I think we can be smarter than that. with the local resources that we have. So I would rather buy an asset that's close to core, but not exactly, and then pay a 5% net initial, where we feel really comfortable on the durability of the income stream based on, again, location, building specifications, and the second life of the asset. So I'm a bit agnostic to where I'm investing. In the mix, we need to pay out 5% distribution. So like last time, after the second capital raise, we bought 3 assets, the high yielding one in Den Hoorn, which cost us 4.5%. But at the same time, we bought one in Poland at 5.64 and one in Madrid at 5%. So in the mix, these 3 assets together make a 5% net initial yield. And thereby we hit the 5% distribution target. So we need to look at it from a fund perspective and build the portfolio in a smart way by being very selective. If you buy an expensive asset in the Netherlands, yes, okay, then we need to offset that by finding an asset with acceptable risk, maybe in Central and Eastern Europe, or an asset with a shorter lease duration where you get a discount on the price. And we also have seen a couple of examples like that. A creative idea that we have is that we would like to create deals from scratch. There's a lot of focus on urban logistics and assets that are not on the market that much. So we think we need to create a deal ourselves by, for example, buying light industrial estates and convert these into urban logistic warehouses together with, and we would like to team up together with DHL, which is one of our larger tenants in portfolio. So they know what they need. And we can find the stock for them, and then we can just team up and buy maybe a 7% yielding light industrial estate, add a couple of loading doors, and make it suitable for urban logistic activities for DHL, and then probably look at the 4.5 or 5% yield for such a building if you convert it. So yeah, these are just some thoughts that we have around future deployment of capital. Hopefully that answers your question.
Yeah, I think you touched on this one in your presentation, but growth plans, are you planning equity raise? Do you just want to sort of explain that again?
Yeah, so at the moment we've invested 400 million. As said, we are ambitious. We want to grow this fund. The fact that we're ambitious is also reflected in our low fund management fee of 75 bips. So we want to grow. But we also want to serve our existing investors in the right way. So 5% distribution, that's absolutely key for now. At the moment, we're testing the market to see if there's any appetite to invest in ASLI. We've done a small tap issue 2 weeks ago. And yeah, we're looking to raise more capital, absolutely. There are a couple of things to consider. First one is, of course, the share price. At the moment, we're trading at a small premium of around 3-4%. That's also what we need because we can't issue new shares when we're trading at a discount, because of course that would be dilutive for the existing shareholders. So that's one. So right now we're in a good position. We're fully invested. The share price is trading at a premium, and we have been bidding on assets. So once we get exclusivity on these deals, then I think it would make sense just to go back quickly to the market and do a tap issue. And a tap issue means we can issue 10% of existing shares at any point of time. So that would mean, that would probably give us around 50 million. And we can do that twice a year. So we can invest quite a lot still in the second half of this year. And we're also thinking about doing a full capital raise, which would mean that we need to update the prospectus and the valuations. But for now, the tap issue looks like the way to follow. And as said, we have this revolving credit facility in place that we can use to buy an asset, get it under offer, do the due diligence, and make it income producing for the fund, and then go back to the market and say, well, do you like the strategy? Do you like this asset? We would like to make a down payment on the RCF, which will then give you immediate exposure to the fund. So there are a few things that we are considering, but yeah, I think this year we will definitely grow based on the pipeline of assets that I see, the fact that we have the RCF, and the fact that we have already done a small tap issue, and I think there's more to come.
Sure. Right, we've got 3 questions to go and only a few minutes, so we'll try and rattle through these. How
Yeah.
do European leases, which are linked to CPI, perform during periods of deflation? Do rents go down?
Well, just depends on the indexation clause. Sometimes you just agree on a fixed CPI indexation, so fixed amount. So we have leases like that. But normally a standard lease agreement has a floor, and the floor means that it can't go below 0%. So there's always going to be a positive indexation above 0% at least, and in some occasions a fixed rate where we just agreed on a fixed number year after year.
Cool. Can you talk a little more about the role of transaction managers and why you feel they give you an advantage in this market?
Well, that's a really important question because that's really our USP. So I'm sitting in Amsterdam in the World Trade Center, and I'm managing European strategy. So I like to believe that I have a good network in the Netherlands with brokers and developers. But you can't cover the whole European market by itself. So if, let's say, in a situation where I didn't have any local resources, then it would be heavily depending on the input from brokers. And you're 100% sure that if a Spanish broker is calling me in Amsterdam saying, well, I have this great off-market opportunity for you, nobody has seen it in Spain, then you're absolutely sure that everybody has seen it, nobody likes it, and he's trying to sell it cross-border. So that's why you need to have a local guy that speaks Spanish. And the example of the Madrid deal is a really nice example on how we have sourced a deal in an informal way. So my colleague in Madrid, he's a big fan of Real Madrid, and he's going to the Bernabeu Stadium every now and then, and that's where he met this wealthy person, part of a Spanish family, who's telling him that he had plans maybe to sell this urban logistic warehouse in Madrid, and he convinced him to give us exclusivity on that deal on an off-market basis. Off-market means that we were not competing with any other investors, where normally the price will always go up during the bidding process. No, they gave us exclusivity on this deal, and we bought it at a 5% net initial yield. And the first valuation immediately reflected that that was really good deal because it came in at a 4.8 net initial yield. So I think 8 out of the 14 deals that we have done were on an off-market basis, and that really shows how strong our relationship is with in these markets. And if you take another example, developers, for example, they want to do a deal with you, but not only that one, but also another one and another one and another one. So if you build up a good working relationship with developers, then you can source the right stock, and they only want to do deals with investors that have a strong reputation in the market. And being the second largest in Europe, and the fact that we have transaction managers, we have technical experts, we have people that can look at structuring of the deal, so we can move very quickly and give security on the deal. And there are a lot of aggressive buyers out there in the market that are willing to pay the highest price, and then during the diligence they try to negotiate the price downwards and play tricks with the seller, with the developer. And that's something they can't have when you're developing, and especially in a forward funding process where you need to pay monthly installments for building the construction. Then you can't have a situation where a seller is giving you a hard time. So that's how we have done lots of deals for our fund.
Sure. Last question, really quickly. Why do you like the Netherlands as such a good logistics location? Yeah, well,
the Netherlands, as said in the outset, is very strategically located. And location you can't change. It's there, and you can just benefit from it. And the Netherlands has always been very much outward oriented. So export has always been a very important component of our GDP. And the fact that we have the largest port in Europe, which is the port of Rotterdam, but also Schiphol Airport, means that there's a lot of trade going on. And the proximity of the Ruhr area in Germany, but also more to the south, Belgium and France, makes this a really important logistic hub in Europe. It's seen as the gateway to West Europe. And that's why I think the Netherlands is a really good market to invest. And there's hardly any supply available, and demand is high. I would bother you with all the details, but there's a big discussion about nitrogen, which basically means that issuing new land is even more restricted than before. So for me as an investor with the 6 assets that I have in portfolio, that's really positive, because that means that the tenants don't have an alternative to go elsewhere. And that means that I can just increase rents more easily than in a market where supply is ample.
Right. Okay. Well, that's all the questions. Thank you, Evert, for your time. And
my pleasure.
We'll leave it there, and we'll move on to the next one. Thanks a lot. Have a good day.
All right. Good luck. Thanks very much.
Right. Well, good morning, ladies and gentlemen. Thank you very much for your time. Appreciate your listening to all sorts of different companies this morning on these series. We're a little bit different. We're actually a fund, an investment trust, which is a closed-ended vehicle that actually invests in these underlying in these listed property companies, as well as some physical real estate, which we'll come on to in a second. My name is Marcus Phayre-Mudge. I've been running the trust now for the last 9 years, but I've actually been working on the trust for over 20. Started my career as surveyor back in the early 90s. And that's very much, and when we look at the team, it's very important that we actually have an industry background. We'll look at the team, we'll look at the results for the year end was March, our positioning, performance during COVID, and a quick outlook as well. Thank you, Richard. So we have to, first of all, just to give you the highlights, were quite big. Net assets, 1.3 billion. We're currently trading at a wider discount to our asset value than we have for quite a long time. We're actually at a discount of about 15%. That's very much occurred in the last month or so. So we think it's a great buying opportunity. Our benchmark is the FTSE EPRA REIT Developed Europe. So that's a pan-European real estate equity benchmark. But we also have some UK physical property, currently about 8% of assets. We can have up to 15%. Div yield, based on the dividend that was declared at the end of with the results in May, for the year end to March, 4.1% div yield on the current share price, and that we saw growth over the year. So unlike a lot of our underlying companies, the board chose not to in any way reduce the dividend. The income had been earned, and that was earned by investors. We do have revenue reserves. They equate to more than 1 year of total payout. So in the event there is a dip in income in the next 12 months, the board have the capability and capacity, whether they do or not is up to them, to smooth that dividend growth. And then you'll hear me talk much about retail. In fact, you can pull up the TR property report and accounts from 6 years ago, when I started bleating about the issues for retail property and for shopping centres, and the issues of the structural shift to online. On the right hand side, you'll see two sets of numbers. The first is our full year results, where clearly disappointingly negative for the year. However, we did beat the benchmark, which is a task the board sets me every year, and I'm glad that we've achieved that every year for the last 9 years. And then at the bottom, I thought I'd just show you, how our performance looked pre-COVID. So very much a reflection on what had been going on in the real estate equity market pre-COVID, and you can see it was a very healthy period of return. The share price had actually done remarkably well. That's because we've moved from a discount to a premium. And then, of course, in the last 6 weeks of the financial year, we moved back out to a discount. Next slide, please. So what do we do? Not just running TR props. We actually run about 2.7 billion sterling of real estate equities. We run in a variety of structures. Property growth and income is a hybrid, so that's a mixture of physical and equities, even 70-30. We run some global capital as well, and we have a long short fund, which is relatively small, and that's quite deliberate. Okay, I won't bang on about those. That's not what we're here to talk about. Thank you, Richard. The team, there are 11 of us, and what you'll see here in the dark blue is how long we've all worked together, and in the light blue is our, adding on our pre-existing careers in the sector. Joe Elliott, my CFO, has been with me for a very long time, as you can see, as has George Gay, who looks after our physical real estate, and Alban London, who's my co-fund manager on a number of other products, and he's lead manager on various other funds as well. He's deputy manager on the trust. Analysts, we have had a series of excellent analysts who've gone on to do other things in other firms. We currently, Paul Gorry came to us from Numis, covers the UK and Scandinavia, and Pierre Perrin, who was previously at Deutsche, covers the rest of Europe, ex-Scandinavia. Okay, if we could move on, please. So the next two slides are just performance data that were required under the FCA rules to put up. You'll see the top bit is just performance on a capital-only basis. The bottom bit is our NAV with income versus our benchmark. So you can look at the performance data at your leisure. Next, please. And this is just a longer-term timeline going back a bit further. And again, the requirement to give you the 1, 3, and 5 year data up to the middle of June. Okay, thank you. Right, on to the nub of the presentation. TR, as in TR Property Investment Trust, originally stands for Touche Remnant, which was a business that was owned by Henderson Investors. We then left there in 2004, moved to somewhere called Thames River Capital, purely serendipitous that they were called Thames River, and of course we therefore kept the name TR. Thames was then sold to F&C. F&C was sold to Bank of Montreal, which is where we are now. We now say that TR stands for total return, which I think is much more appropriate. And what you'll see is that dividend has been a crucial part of our total return. And really interestingly, in the investment trust world, this is a very, very strong growth rate, 9.4% CAG. And you can see in the bullet points that our earnings for the year were 14.6 and the dividend paid out was 14p. So again, we just added a little bit to our reserves, and there the comment about the revenue reserves equating to the 1 year of revenue distribution, which we wouldn't ever need to use all of it, may dip into a bit. Okay, next please. And then the portfolio composition, as I mentioned, we are on the left-hand side, 7-8% direct property, that's just rounding. And then the fund, it's very much predominantly continental Europe, with only about a third of our exposure being UK equities plus UK direct property. And then when you look at our continental exposure, you will see very, very heavily weighted towards Germany. Austria is a tiny part, we just added it in. And then France and Sweden are our next biggest markets. And next slide, please. And then our top 20 positions, which equal 75% of our exposure. Some of these names will be very familiar to you. There are clearly the very big companies, the likes of Vonovia, and we have some Unibail in there. You'll be like, well, hold on, you're miserable about retail. Why have you got Unibail? This is really a function of valuation. The stock has utterly collapsed, and we actually have a market weight holding in the company. We don't have an overweight. The third name on the list, Argan, is a stock that you may well not have heard of. I encourage you to have a look at it. It's a French logistics business. It's 50% owned by the founding family, the Lalonde family. It's been a fantastic performer for us, very much caught the zeitgeist of logistics. They are thoroughly embedded in their domestic market. Great business, did a huge deal with Carrefour last year, but they're going back. They've built some very, very large big boxes. And what we really like about, we're very long of the logistics sector, have been for many years, but we're particularly attuned to those businesses that own land and can make those development gains. So not only do we own Argan, but VIB in Germany, Catena in Sweden, Montea in Belgium, WDP in Belgium as well. some WDP, Warehouses to Power, you may have heard of. The others are much smaller companies, and that's a key point about TR Properties. Part of its sort of secret sauce is it is closed-ended. It does allow us to invest in some relatively small companies, help them grow. We've backed a number of IPOs. We think that a lot of businesses trade on large discounts to asset value while they're small, and then the market either discovers them, or because it's real estate, if they don't survive, they get taken private. And also we often find that these smaller companies, there's very strong owner-manager interest, and that's absolutely crucial. These are not businesses run by journeymen who are just there to make a few quid and move on. They're generally founding, and we've had a lot of success. Yes, CLS Holdings, 50% owned by the Morsted family. Lots of great businesses that have strong family ownerships that we've been involved with. ANJ Mucklow, Green REIT, Terraris in France, Big Yellow Self Storage. The list is long. Okay, let's move on. We've got more names that we'll talk about. Thank you. So here is just looking at our country exposure in a bit more detail relative to the benchmark. And I think it's important, you know, given that I wrote in the annual report the last couple of years what concerns we have around the UK, particularly in a post-Brexit environment, and people are always surprised at how long we are relative to the benchmark exposure. So on the right-hand side, we go some way to explain that. First of all, we hold a lot of overweights. Overweights in alternative space. So these are businesses that aren't necessarily going to be as impacted by pure economic performance. So we look at healthcare, student accommodation. The middle group, Stenprop, CLS, Phoenix Re and Sirius, are all businesses that are listed in the UK, but actually have the majority of their assets in Europe. So Sirius is Workspace, again, have a very good performer. Phoenix Re is Berlin residential. CLS is 50% UK offices, 30% Germany, 20% France. And then Stenprop is a business that has had a lot of European assets, but it's busy rotating and becoming a multi-let industrial owner in the UK. And then the bottom are long income players, Supermarket Income REIT, which has been a stunningly good performer through COVID, and then Secure Income REIT, which has really had a lot of difficulties and headlines around this travel lodge, etc. Exposure, but they seem to be out the other side of that, and that's excellent. Okay, if we could move on, please, Richard. And then the subsector positioning. This is really important. It's how we look at the world. If you look on the left-hand side, you'll see that some of these segregations are pan-Europe. Some of them are country segregated, and some of them are just continental Europe. And it's very much we're trying to put our stocks into groups where we think that they are all going to experience the same, broadly respond in a similar way to a macro response rather than a micro response. And then you can see quite clearly where we've, markets that we clearly favour, industrial, UK diversified is some of our small cap names in the UK, which we'll come back to, so the likes of Mackay Securities, Stenprop. And then German residential, supermarkets, these are all businesses that we are long of, German offices. And then on the short side are relative underweight relative to our benchmarks. My job is there to beat the benchmark. Come as no surprise, European shopping centres. UK majors, we're underweight the pair. We own some land securities. We don't own any British land at the moment. Happy to take questions on those. And then Switzerland, we feel that it got very overpriced. In the early part of the year and tail end of last year, and we've very much moved to an underweight position, and that's been right. The stocks have not performed well relative. Okay, moving on, please. And then just to sort of something that all of you will know, but looking at the year to the end of March, best performers and worst performers. The ones on the left, I think, are the ones that will all be very familiar to you. They are all retail names, so no surprise there. And then on the best performers, the things that might surprise you, SBB is actually a Swedish business that invests in effectively community-based properties, so schools, hospitals, nursing homes, but all let on very long income, long leases, basically to local authorities. And of course, that has very much caught the zeitgeist of the market because it's a long and strong income stream. Kojamo is a business that we've been heavily invested in. This is Finnish residential, and that's enjoyed a very, very strong return. And then Assura and PHP Healthcare has done very well in the last 12 months to March. And then WDP being our top performer in the logistics space over the year. This is obviously the Belgium listed logistics owner developer. Okay, next please. And then this is a lot of data on this slide, but I thought I'd just turn to how real estate equities have performed sort of since COVID. And what you'll see in the second column is how the market performed from the last sort of the peak, pre-COVID peak, which was the 19th of February, down to the 18th of March, the most recent trough, and then the bounce from the 18th of March up to the middle of June. Sorry, the slide's slightly out of date. And then the read across from February to now. And the important thing is if you look at the names at the top of the second column, so supermarkets, German residential, industrial, UK healthcare, they fell the least in the downturn, and then they bounced the most subsequently, leading them to be at the top of the leaderboard for the period from February to now. And then at the bottom of the stack, you had those groups of names that fell the most and then effectively bounced the least, and that's left them at the bottom of the table. And again, none of it will surprise you, although possibly Stockholm offices, which is particularly related to two particular companies. Clearly UK retail, the majors, hotels, European shopping centres, and then student accommodation has had a very difficult run. Unite, a great business, but clearly there's still insecurity as to whether tertiary education will reopen in September, October. We think it will. We think students will return home. I think for most of us who look back at when we were 19, 20, 21, to have spent the last 100 days at home when you could have been out with your mates, is meaning that I think people will be keen to get back to university. And actually, sadly, in recession periods and difficult economic conditions, you actually find that more young people do continue their education rather than try and get jobs which are very hard to get. So we think that's likely to be a positive there. Stock has been absolutely hammered. It's gone from £13 down to £9.50, and we think it's a buy at these prices. Okay, next please. And then just to sort of pull it all together, where are we and our positioning? What's very much worked, not only post-COVID but pre-COVID. It was very much that sheds, meds and beds theme. Residential, in this, just to those of you who aren't familiar, in Germany, this is kind of PRS on an industrial scale. Vonovia, the largest company in our universe and a very big overweight for us, has close to 400,000 apartments. It's expanding now from Germany into Sweden, into the Netherlands. Great business, and you've got a situation where rents are controlled through the Mietspiegel. So your customer is paying a sub-market rent. That rent is indexed, broadly index linked. It is growing. You've got virtually 100% occupancy, and of course you have a virtually 100% rent recovery. If you are laid off in Germany or furloughed, the state will step in to pay most of your rent. And we have virtually no delinquency from our German residential names: LEG, TAG, Vonovia, Wohnen, and Phoenix Spree. And then healthcare has been really strong, as you can imagine. Funnily enough, in the bounce of the last couple of months, it hasn't really outperformed, but we still think that there's the risk, of course, is to a second wave, and we want to really what's the key positive? What's the key attribute that broad generalist investors are looking for from their real estate exposure? And the answer is long and strong income, and we'll come on to that a bit later in a moment. And then student accommodation, well, we think it's going to be one of the strongest performers in the event of a V-shaped recovery. It's quite binary. if universities do reopen and students do go back, it will perform very well. And then you'll see on our underweights, we have very little non-food retail. So no Intu, no Hammerson, no New River, Capco, no British Land actually. And then in the European context, we do have some exposure to Unibail, Eurocommercial, Mercialys. Mercialys has about 35% of its income actually coming from hypermarkets, a small company, but it's imagine, you know, when you go on holiday to France, there's that massive Carrefour, Casino, Auchan, and then the few shops attached. It's very much that. They own lots of those. And again, this is a function not only of where these prices have fallen to, but also the fact that the rents in Europe are much, much lower. The greatest scourge for UK retailers and for UK retail landlords has been our terribly unfair rating system, where, you know, the logistics operators and the Amazons of this world pay very little rates and rateable values, and are way too high, and it's a massive property tax, which ultimately falls to the retailer, to the tenant, and he can't afford to pay, and he's walking away. Now, you just haven't got that same situation in Europe. You know, so the occupancy cost ratios in Europe are much, much lower. Richard, I haven't got a clock on me, so you'll just have to put up your hand and tell me when I've got 5 minutes to go. And then the exception, of course, we've mentioned Supermarket Income REIT, fantastic business. We backed this company at IPO. It's been busily growing. We've been delighted with its performance, delighted with what the guys have been doing there. And then more recently, in the last 12 months, we've also bought into a business called Cibus, which is the sort of Finnish equivalent of Super, and it owns supermarkets in both Finland and Sweden, and has actually been a very strong performer again. Again, the theme being this recurring strength of income, index linked. To be quite honest, if you could, I don't know what a Tesco 10-year bond is trading at today, but it's probably circa 2%. And at the end of the 10 years or whatever, how long on the long dated stuff, you'll get your capital back. Whereas you go and buy shares in Supermarket Income REIT, it's yielding you 5.5%, and that's index linked income. Okay, next please. Okay, briefly on our physical property portfolio, as I said, 8% of assets. It enjoyed actually a 7.5% increase in valuation in the second half of the year, that's September to March. We own two types of real estate: long-term regeneration assets that we've owned for a very long time. We'll talk about those in a minute. And then just really where we have opportunity and we think we can buy assets that there are moments where the equity market can overprice. You know, stocks move to premiums to asset value we think are too high. And we had moments of that in the last couple of years, particularly in this sexy sector of industrial logistics. So if we can find physical assets that we can buy, effectively at NAV, we know what we're doing, we might as well do it ourselves. Okay, next please. So here in Bayswater, some of you may be familiar with this block of quite ugly yellow slip brick at just sort of bottom of Queensway. Haven't got time to take you through it, but we had a little Waitrose supermarket tucked around the corner, and we managed to persuade them, and they wanted to. We didn't need to persuade them very hard. They wanted to double the size of their unit, and we said, well, look, we want you to go at first floor level because we want to keep the ground floor for retail and restaurant use. And they said, really, how many supermarkets do you know at first floor? And the answer is not very many, but they were so keen to get here that they agreed to it, and it was showed a lot of foresight on their part. Bottom left of the right-hand picture, you actually see the escalator and travelator going up there, and it's been a fantastic store for them. The ground floor, we've got Graham and Green, we've got a gym, one Rebel, Specsavers, and a restaurant unit that unbelievably is under offer, and we'll see how that gets on in this current crisis, but we're still hopeful. And then the upper parts are all residential, where we've been able to sell. When we bought it, I bought it 15 odd years ago, had quite short leases. They were sort of 60-year leases, then our 45s, and we've been busily selling extensions on those. So an exciting project. taken us a long time, but it's been real success. Next, please. And then at Ferrier Street, Wandsworth, for any of you who are based in London, and you'll be familiar with the Wandsworth one-way system and the roundabout, Tonsley's, and a pub called the Alma, which is quite well known amongst the surveying community. You stumble out at the Alma and you're looking at this picture. That's our industrial estate, the Ferrier Street industrial estate, which again I bought back in the 90s, originally off £8 a foot. And we're now getting £24 a foot, but even with rents at that level, still made sense for us to go and seek a planning permission, which we received in November from Wandsworth Borough Council, to add about 3.5 times the square footage to this site. Our existing leases don't expire until next year. This is going to be a mixed-use scheme, part residential, part office, part light industrial on multi-level light industrial. We have a lot of food users in the current scheme, and a number of them have shown a desire to be here. We think we're one of the 2 closest sheds to Hyde Park Corner. It's a fantastic, effectively central London location for an industrial estate, and it's been a great asset for us. Next, please. And then just to come on to and summarise, this is a slide I've been using for many years. Why is it okay to own real estate, and why should you own it now? The first point is the fundamentals. It's an income stream with that capital kicker. You're getting that yield comparison, that margin over fixed income, and I use the example of the Tesco bond. And then of course rental growth. Now clearly, your rental growth has been strong for a number of sectors, ex-retail. I'd now describe it as stable for asset classes ex-non-food retail. And of course, we have concerns about where that demand is coming from. In the short run, we've got a lot of concerns around office markets, and those are totally valid. But it's not, just because we're all sitting at home, working from home at the moment, and we find it hard to envisage going back to the office. I think our conclusion is we are going to go back to the office, but we are going to work more from home as well. The question then is, how much office space do you need? And that's going to be really about the de-densification. And actually, a lot of companies are going to find they probably need the same amount, even though they've only got half the team in there on a Monday and the other half in there on a Tuesday. But that's all sort of to an extent is going to unfold in the coming months and years. But I think one must be careful not to be a massive bear about office markets. And the main reason you shouldn't be an office bear is pre-COVID, the central London office market, of all buildings that were due to be completed in 2020 and 21, 65% of them were pre-let, i.e. there was very, very little supply in the market. So it's not as though we've gone into this crisis with an abundance of empty buildings or anything. And in fact, what you can be pretty well damn sure about is not only do we have a non-existent development cycle 08 to 14, which I've come back and talk about in a moment, but more importantly, I added to this slide, for those of you who've seen it before, the words deferred development cycle 2021. People are not going to be starting those spec developments now. They need to work out, do they need to change the consent they've got, the design of the building? Do they need to have more open space, different circulation, more outdoor space? They're probably going to have to increase the number of showers, storage for electric bikes, etc., etc. Things are changing, and this will going to lead very much to a pause in development while people work out what they're going to do. But just touching back on that non-existent development cycle, this is really, really crucial. And whilst property had clearly a very difficult GFC in 7, 8, 9, the consequence of that is the banks stopped lending. And what we've noticed, globally, but particularly in Europe and actually in North America, less so in Asia, but certainly in Europe and North America, was that the banks stopped lending, and it took a long time for other forms of funding to sort of step into the gap. And as a consequence, in many, many sectors, we've had, record levels of low delivery of new space. Now, the exception, of course, is retail, where we didn't have any new space, but we had far too much of it. So we had a glut and an oversupply, and tenant demand collapse, etc. So obviously all my comments are ex-retail. And then when we look at valuation, we've got a situation where the only stocks that are standing at premiums to asset value today are those that are genuinely showing rental growth. And that's industrial, that's logistics, that's warehousing. And then the long income streams, I think, still look very good value. If you think you can buy a supermarket income REIT of a dividend yield of 5.5%, you can buy a Schroder and PHP of 3.5, 3.6% index linked, effectively government backed, NHS backed. It looks great. And then the debt costs continue to fall. We've got a situation now where we're back into a lower for longer environment. We've got real rates are negative, nominal rates are zero. We've got capital repression. What I mean by that is you've got long-term funding institutions, pension funds, insurance companies, etc., are really forced into buying in these bonds, even if they're of negative yield, and that's because they've got to match their liabilities. So just to conclude, I think on the next slide, Richard, is the final one. I'm sure I must have run out of time, so I'm going to bore myself. Definitely must be boring you folks out there. But really, to bring it all together, those first bullet points are very much what I've been talking about. Then we look at the penultimate one. This issue is a cash flow demand strike. It's not a balance sheet crisis. We don't expect to have a repeated. We're not going to see a huge wave of deeply discounted rights issues, except little asterisks, except potentially in retail. Obviously, it's all too late for into, but there are other businesses that, the stock market clearly is valuing. I think Hammerson's share price is about 84 pence. Its last published asset value began with a 5. We think its real net asset value begins with a 3. But even therefore, at 80 pence, why are we not rushing out and buying it? It's because we think that it's still highly likely, if it's not able to make sales, that it will need to find some forms of additional capital. For example, it may well happen across Europe as well. There have been some offensive capital calls already. We've seen good quality businesses trading at premiums coming out and raising capital, not only because they see opportunities around, but also to some extent doing a little bit of de-gearing as well, which is in some cases a bad thing because they now have a sort of slightly flabby balance sheet. But in other cases, it's a good thing. They've got opportunities, and then of course the defensive ones will be the sort of deeply discounted rescue situations will be further down the line. There'll be those companies have been trying to avoid it. It's obviously terribly destructive, but we fear it might come. It might not. It might not, and that would be good if it didn't. But obviously, we have to roll out some of the 2008 playbook. But generally, it's not going to be the case. We're going to see a lot of dividends reinstigated. We've seen some suspensions, some cancellations, but we think there'll be, come the autumn, we'll see some dividends reinstituted. Okay, I think that's probably it for me, Richard. I've sort of cantered through that. I hope we've got a couple of questions, but
yes, we do.
But over to you.
Thank you, Marcus. Right, first one from Justin Bell. Do you have any concerns over the pricing of supermarket assets? For instance, the Waitrose sale and leaseback that Supermarket REIT and London Metric executed recently at 4.4% yield.
Excellent question, Justin. The answer is no, I don't, because again, it comes back to the fact that these are index-linked income streams, which makes them very valuable to investors in a very low bond yield environment that we're living in. I think that what the supermarkets have shown collectively is that whilst online delivery is increasing, they are capable of managing the process. What I mean by that, and if you look at why Amazon spent a lot of money on Amazon Fresh, and that failed, and then it went and bought Whole Foods, is the fact that the online delivery of the future, because we are all going to have more things delivered online, delivered to our homes, be it food or non-food, is that it is going to be the existing supermarket operators that dominate that. And actually, of course, the people who've been eating the supermarkets lunch, excuse the pun, obviously have been the hard discounters, Aldi and Lidl, but they're never going to do an online service. home delivery, and therefore that leaves it open to the other players, be the large ones, Tesco, Sainsbury's, or the small ones, Waitrose, Morrison's, an opportunity to make money out of that business. So we are quite comfortable with those prices paid, and to some extent you're going to get a bit of a squeeze, and it's going to be around for a while, because the retail sector is effectively uninvestable at the moment until it sorts itself out. So that squeezes capital into other areas. But if you think that Waitrose is a perfectly reasonable covenant, and there's a business that's going to be around for many years to come, an index-linked income stream of 4.4 is quite attractive.
Cool. How does a private investor work out the operating costs if no TR is shown? What does TR prop do?
So TR prop, there is some data in the annual report. In effect, I think you kind of have to trust that I work very hard in dialogue with the boards of many of the companies that we invest in, to make sure that we keep C-suite compensation at appropriate levels, that we tie that compensation to the performance of the business. We work very hard. At the end of the day, it's these companies, if they do have artificially high levels of cost of debt, or they're over leveraged, they will suffer, and the share prices will fall. And that's exactly what we've seen with the likes of Hammerson. In terms of I accept that it's apart from me drilling down into the operational costs of each of my individual companies and then running a see-through for you, that would be a bit harder. But if you're interested in what are the costs of TR property, our total expense ratio is I think about 90 bips. But I'll come back to you if you leave your name and number with Richard. I'll come back to you and tell you exactly what that is. But remember, the TR property, unlike other investment trusts and unit trusts, we don't actually have an ad valorem management fee, i.e. we're not earning on a percentage of assets. It's a fixed fee, which the board renegotiate each year, plus an element of ad valorem, plus a performance fee if we beat the benchmark after the hurdle. And the point there is the board feel then that I am very aligned. I'm very aligned to shareholders in delivering that relative outperformance, and that's absolutely crucial for what we do. I hope that answers the question. If it doesn't, I'm sorry. Just send it to Richard, and I'll answer it properly.
Yeah. Right. We've got quite a few questions and only a few minutes, so try and answer them quickly. Is there a double discount opportunity for investors at the moment, with your shares at a discount and the underlying investments also at a discount?
Yes, absolutely. I am not on the board, but I own. I have, after my house, my next largest investment is in shares in TR Property. I like to eat my own lunch. The children's junior ISAs, my wife's pension fund, they're all in it, and I bought shares in the recent past.
Cool.
That's to give you any indication.
Yeah. Are retail funds underpriced and good value at the moment, or do you still think there's some way to go?
If you mean retail companies,
yeah,
property companies, in some instances we think that they may be closing in on trough valuation, particularly on the continent. However, we do need to see. We're remaining cautious, and we do need to see how the rent collection goes in the next couple of quarters. On top of that, the question is, are these things, ultimately then slightly dead men walking, i.e. they survive but they don't thrive? For the UK names, I'm afraid we have concerns over the likelihood of them needing to strengthen their balance sheet in the coming months. So no, we're steering clear in the UK.
Cool. I think you've touched on this, but if you want to add to it, what's your views on the office market post-COVID?
Yeah, I think, as I said, it's a two-way pull in terms of more working from home, but more de-densification. I think the densification is a very important point. When I started at Knight Frank and Rutley, as it was then in 1990, we had about 200 square feet per person. That got down to about 70, 75 in a modern skyscraper in this decade, and we may see, and that has enabled tenants to pay a lot higher levels of rent because they squish more people in. If that reverses, you may not see as big a collapse in demand for office space as the naysayers are suggesting. We may also see some decentralized locations benefiting. So I think the answer is, I think the jury remains out. Share prices have reacted significantly. I mean, Derwent London's gone from £42 to 29. That the market is definitely pricing in some certain amount of falls in rent. But one thing I can be sure is, which is a theme we've seen running for quite a while now, which is that tenants are prepared to pay more for better space. Their most important asset is human capital. And you get a lot greater productivity. You attract, particularly attracting in markets, the tech world where you're competing for talent. If you're able to show a potential and software engineer the type of environment he or she's going to work in, which is so much more attractive than the company down the road, that's great. And we've seen that. We've seen tenants prepared to pay best-in-class prices for best-in-class assets. And that will persist. So back the developers. Yeah,
cool. And last question on universities. In the US, they are shifting online, and there's a real risk that university students won't be returning anytime soon. Are you confident about their return in September here? And might students not take gap years in the hope that things will get better? And will foreign students even come here?
Yeah, lots of questions there. Very good questions. So the first point is, yes, we think that the very large lectures, if you remember from your student days, a couple of 100 of you squished into an auditorium, listening to a professor talk, that is going to, that can't persist. So they're either going to have, you're going to be much more distant, but the tutorial structure and working remotely is absolutely going to be, we think, very much the way forward. Students will therefore want to be on campus. They are still going to meet with their professors. There still will be tutorials, different sizes of groups, but those very large lectures will be replaced entirely online. We think that, so that's the first point, and why I think, this is not the end of tertiary education. And to be quite blunt, it's very, very difficult for a lot of students to remain at home, as it were. So they may need to go back to their student digs, even if some of what they're doing is online rather than physical. But they'll still want to be able to return to socialising and playing sport, etc., etc. So we think that that is that's going to happen. In terms of why not take a gap year, you're absolutely right. The problem you've got at the moment is you can't actually go where you want to go on your gap year, because we've only got 60 odd countries that you're actually allowed to go to at the moment. So it's a real dilemma for students. Coupled to that is, when you come back next year, you're competing again for your place against another intake. And the whole thing just sort of backs up, really. The issue you have, which so not to push back on all your points, the very valid one is foreign students, absolutely, and that is the major risk. And we see a significant reduction in the number of students, particularly Asian students, that are able to come. But I think we also got to be a bit careful, because will have students who are thinking were thinking of going to a US university, and they cannot do that now. It's very, very difficult for Asian. Long before COVID, Trump was making life very difficult for Asian students to come, and we were very much welcoming Asian students with open arms, and it's a very, very important export for the UK, tertiary education of foreign nationals, and I think that will that will have its own pressures, but we must accept, and we're already modelling quite some reduction for this year. But bear in mind, if you've got an empty student accommodation block in central London, you may well need to move that to some form of AST, short-term let it out to the local authority won't want to see it sit empty, so you may have an opportunity to look at turning it for a period of time into open market rental accommodation.
Cool. All right. Well, we've just run out of time now, so yeah, thanks a lot, Marcus, for your time and your insight there. Thank
you, Richard. If I can make one final comment. The TR Property AGM is normally held on the 27th, 28th of July. Obviously, it's a closed meeting this year. The presentation that I would normally give at that is up on the website. It's very similar to the one I've just given to you now, but if there are any particular points that you want that you want to sort of hear again, it's about 22 minutes, so you can fast forward to the bit you want to hear. But there's more colour on that about our portfolio. Particularly our portfolio composition. And
right.
Thank you very much for your time. Thank you, Richard. Have a good day.
You too. Cheers.
Bye-bye.
Thank you. Right, well, good morning, everybody. And it's good to have the opportunity to speak to you. Hopefully you can see me. For those that can see me, as well as being in desperate need of a haircut, I am also the fund manager of Schroder Real Estate Investment Trust. So what I'll do today, I'll give you an overview of the company. I will give you our thoughts on what's happening in the direct real estate market, where we're invested, tell you why we think our portfolio is well positioned for what we're currently experiencing, and also give you a quick synopsis of how we see the outlook. So just moving to the next slide, or the one after, just some headlines for those that perhaps don't know us. This is a company that is investing in direct UK real estate. So we are owning and asset managing the underlying assets within team at Schroders. The real focus here is on sustainable net income growth. Unlike some of the managers you're hearing from today, our focus is on owning a diversified portfolio, but with a focus very much on what we call winning cities and regions. So the higher growth parts of the UK economy, regional cities such as Manchester and Leeds, but also the sub-markets in central London, where we believe we will see stronger returns. We're focused on buying assets with strong fundamentals. It's not quite true to say that we're buying the worst house on the best street, but it is true to say that our philosophy is to buy mispriced assets, but in very good locations with good fundamentals that we can then asset manage and drive value. We have a cautious approach to leverage. We have a focus on delivering an attractive dividend for shareholders, and so actually we've tended to hold our leverage at a range of between 25 and 35%. And as I'll come on to talk to you in a moment, partly because of what we're seeing with COVID, but also actually because of concerns we'd had prior to COVID about the market cycle, our leverage is at the bottom end of the range currently at around 24%. Unlike some of the specialist companies you're hearing from, and in common with many of the more balanced portfolios, our shares are trading at a pretty significant discount at the moment. So our net asset value that we announced as at March year end of around 310 million and reflected about 60p a share. Our current share price is around 34 pence a share. So you can see there's a very significant discount, and we would argue, and hopefully what will come through this presentation is that we represent good value. We have, as a result of COVID, postponed the dividend, and I'll come onto a slide in a moment which explains why and the potential direction for dividends going forward. But I think most importantly, because of the steps that we've taken, which I'll move on to the next slide, we have a very strong balance sheet with significant cash. Before I move on to just explaining a little bit more about that, is probably just outlining our performance. So whilst we've seen particularly recently, the share price discount widen. Actually, the approach that we've adopted through actively asset managing the underlying portfolio, and by having, in our view, exposure to the right parts of the UK market, means that, as you can see in the bottom right-hand corner of slide 59, we've had sustained outperformance of the underlying portfolio. And this is over 1 year, 3 years, and going way back to inception or IPO of the company in 2004. Why is that? Well, as I say, it's partly to do with the asset management, but if you can see on the top left-hand side of slide 59, the green bars represent income, with the blue bars representing total return, and we're comparing ourselves on the left with the MSCI benchmark index, which includes all of our peers, both externally managed as well as internally managed. And you can see the key reason we think for that outperformance is that higher income return. And over the 12 months to March, our income return of 6%, so materially above the average for the UK, compared with the average there of just over 4%. So moving on to slide 60 in your pack, that's the Your House is a Risk warning. But moving on to slide 61, please. So what have we been doing? This is an extract from the recent year-end results presentation. And this is really a pre-COVID snapshot, if you like, of what we were doing. So we had, as I said, some reservations about where we were in the UK cycle. We obviously had the Brexit risk, which we still have, but we were concerned about pricing in parts of the market, recognising the market was very polarised. So what we did during the course of the last 18 months was sell £95 million of assets. It's a significant part of our portfolio, which is now around 400 million, at a very low yield of about 3%. With the focus on net income growth, we did a major refinancing of our loan facility and reduced the cost of that loan facility from about 4.5% down to about 2.5%. And we locked in that long-term loan financing for 16.5 years. And so what we've done is give ourselves, if you like, a bedrock of long-term, low-cost debt that allows us then to get on and execute the strategy. We've very, very aggressively actively managed the portfolio, and I've got some headlines here that I won't talk to in detail, but the focus here was on improving net income and obviously also improving the defensive qualities of the portfolio. Now, the culmination of all of that pre-COVID was that during last financial year, we increased our dividend by 2.5 million, or about 20%, to an annualized run rate of about 16 million. Pre-COVID, that reflected a yield on NAV of around 5%. Based on today's share price and noting that we've postponed the dividend, that reflects an implied yield of about 9%. So you can see how discounted the shares have become as a result of the impact of COVID. And as we move on to the next slide, we'll illustrate how, through further activity and critically the acquisitions that we think we can do using the capital that we've got, we can move dividends forward. So just to explain this slide very briefly, on the right-hand side, we've got the income statement for the year end for 31 March 20. And so you can see there the net rental related income of 24 million, net income of 12.7 million, and with the dividend, annualized dividend at the end of the year of about 16. So we were there or thereabouts 85–90% covered. The reason we were uncovered is because we'd sold assets, and the expectation was that by deploying capital, that by deploying that 60–70 million, it would move us back towards being fully covered. Now, of course, what's happened in the intervening period is that COVID has happened, and we've been trying to understand the impact of rent collection on dividends going forward, and we have the principle that we're only going to pay dividends where they are sustainable. So on the right-hand side of this chart, we're illustrating how, based on rent collection, and we're currently approaching 80% for the March quarter, and we will be announcing our June quarter collection rates with the NAV in a week or two's time. You can see how, based on the 75% collection rates, the run rate for net income was around 50% before we invested new capital and drove income further. So the decision we took was, let's postpone the dividend with the expectation that we'll get greater visibility about recovery rates, which we're now getting, and there's an expectation that we will see that recovery, and then over the course of the next few months we will then make a decision about at what level and how quickly we reinstate the dividend, and the potential for us to also, if you like, catch up on the dividends that we have postponed for this period of time during COVID. So moving on to the next slide, just to sort of a what next in terms of our strategy. Clearly there is tremendous uncertainty out there at the moment. and although we are beginning to see signs of life, and I'll talk to the market slides in a bit more detail in a moment, there is still the risk of a second wave. And so I think it is right that we're approaching this cautiously. I think it is also true to say, and I caught the end of that last presentation, the structural trends that we're already seeing over the course of the last few years, we've been investing in line with, so moving away from physical retail, moving into industrials. COVID, we think, will accelerate that, and we're already seeing that. And we will look to evolve our strategy for it. The key thing, as I say, is whilst we are expecting asset values to fall in the UK by an average of around 10%, we're on the right side of that. We have the cash of about 85 million, and we can, we believe, again, without wanting to be too opportunistic, invest into the market later in the year at more attractive prices to get back to delivering our objective of sustainable net income growth. So moving on, just to talk briefly about the market before then we talk to the portfolio. So if we just move on to slide 64, 65. So some of these points may have been covered by previous speakers, but you can see on the left-hand side the March rental collection data, which we've broken down by sector. No particular surprises here in that obviously it was a leisure, particularly the shopping centre sector of the retail market, where rental collection rates have been particularly poor. In contrast, obviously, the office sector doing much better. We've been part of discussions with the British Property Federation and government around the code of conduct that the MHCLG have introduced, which effectively encourages landlords to behave reasonably, which we believe we have been doing, but equally tries to address the situation of tenants who can pay but won't pay. And there are no doubt retailers who can pay, but are taking advantage of the moratorium on forfeiture, which prevents landlords from taking the action they would normally do to recover rents. Now that's being unwound at the end of August, and that will be a trigger, we think, to seeing rental collection rates in parts of the market improve a little bit more. Right-hand side, again, no surprises. The investment market has been incredibly slow. People have not been able to get out and look at assets, but we are beginning to see a bit of a recovery as people return to the office, as people are able to either inspect assets or do virtual viewings, and we believe, with assuming we don't see a significant second wave, we will see the market recover as we move. Next slide, please. Capital value. So the key point on here on the left-hand side is polarization. You can see that, if you look between the end of 2017 and today, average shopping centre values are down about 40%. Now, we don't own any, we have no shopping centres, but you can see there the polarisation, the blue line there for average all property in the middle on the left, but with offices and the industrial sector in particular, seeing a slow, more recent decline in values because of the COVID uncertainty, but tremendous polarisation in returns, which we've been expecting. On the right-hand side, this is interesting. This shows you the interquartile range of the valuers who value the big open-ended funds. And you can see that the COVID uncertainty led to that range of value spike as valuers took a different approach to how they assess the risk of COVID. You may know that the material valuation uncertainty clauses that were introduced are now beginning to be removed from certain sectors. And although that's not enough yet to mean that the daily price retail funds are required to open again or to unsuspend, we think that could happen towards the end of the summer. And that's one reason why we think there could be further volatility in values, and why actually also we think they could be a good source of us deploying our capital, because a number of those funds do have redemptions and may need to sell assets in order to fund those. Moving on, slide 67. I think unlike previous cycles where the real estate market has been its own worst enemy, interestingly, this cycle we've been more disciplined in terms of building new space. So although, as I've just heard, and I think I agree with Marcus's view that we will see increased levels of working from home, but actually for communication, for sharing ideas, for meeting clients, the death of the office is grossly over-exaggerated, and I think that will be particularly so if we see improvements with the vaccine next year. But notwithstanding that, even if you took a more conservative view of that, actually we're starting with quite a good place, because actually vacancy rates in most of the key markets are low, and the pipeline looking forward, partly because there hasn't been this speculative development funded by banks this cycle, the pipeline is also quite low looking forward 2 or 3 years. So moving on, as a related point on the left here, I think, you know, you can see on the left-hand side that the net commercial real estate lending in the red bars, and you can see compared with the previous boom, it's been under control. We haven't seen, as we saw in the boom years, this sort of manufacturing and packaging of CMBS loans, and so that has led the banks to be more cautious in their approach. So I think that is a positive. Also on the right hand side, you can see, you know, and again, particularly in contrast with the 2006 to 2008 period, you know, we have a huge yield gap within the real estate sector over the traditional sort of risk-free rate of a 10-year bond yield. Now, and that's illustrated, I should say, by the blue bars here, where you can see there's a negative gap in 2006, and you can see the gap now between 10-year bonds and average property yields, you know, well into the mid 400s, and it's never been at that level before. So whilst we are recognizing the fact that 10-year bond yields are down there for a reason, and that could imply that we would see lower growth going forward, the real estate sector continues to offer a very high yield premium. And even though we do think we will see rental values decline across the market, there is that buffer, we think, to limit that downside risk. Moving on, just to finish off before I move on to our portfolio and how we are positioned. These are forecasts, so the only certainty here is that they'll be wrong. But I think what they do illustrate is, first of all, the polarization. And I think, you know, even with the tremendous uncertainty that, you know, let's be honest, we all still face around markets, the relativities here, I think, will be right. So we are expecting that shopping centre values will take a further leg down, particularly if we see whether it's the open-ended retail funds or indeed local authorities who've been an investor in that sector needing to sell. I think we see retail warehousing recovering a bit more quickly for reasons I'll come on to. They are more adaptable. They do have greater ability to accommodate click and collect. They do at the moment obviously offer much easier social distancing for retailers, and from an affordability perspective, we think that they've always been more affordable than shopping centres. But then again, no surprises, we do think it's going to be the rest of the UK office market, the industrial sector, and parts of the central London office market. We have some concerns about supply in the City of London, but parts of the London office market, particularly where, you know, you've got the ability to attract the talent, the tech, interestingly life sciences, where we'll see a lot more investments, but also public sector and admin, where we think we'll see increased employment, obviously partly as a result of government stimulus. So moving on to the final section of the portfolio of the presentation, before we then take questions. So I talked at the start about how we were positioned, and whilst we do have a balanced portfolio, and I think, you know, that is part of the reason I think why our discount is where it is. We think we've got assets located in higher growth locations where we will see a stronger recovery and we will see better returns. If you like, don't take my word for it. What we can do is map our portfolio looking at Oxford Economics data, the forecast GDP growth, and compare that to the average for the UK. So it's a bit of a blunt instrument, but what you can see on the right hand side is 64% of our portfolio is located in towns and cities of the UK which have materially higher than average forecast GDP growth. And you can see in the light blue and the purple there, a materially lower part of our portfolio is located in towns and cities where we believe, or Oxford Economics believe, there are lower growth prospects. And that's been very deliberate. We have been selling out of smaller assets. We've been increasing our investment into bigger cities like London. We've been increasing our investment, and Manchester I should say, we've been increasing into big multi-let industrial estates on the edge of dominant cities such as Leeds. So moving on, a little bit more detail on our portfolio, so don't worry, I'm not going to talk through all of these numbers, but on the left hand side you can see, it's actually a slight formatting issue, but just to explain, on the left hand side, this is the valuation information as at 31 March. And we'll be announcing our June NAV over the course of the next few weeks. The column of numbers on the left-hand side is our portfolio, and on the right-hand side it is the average benchmark index. And I think the key point to note here is and particularly with the dividend in mind, is compared to the average portfolio in the UK, we have a materially high yield, not just in terms of the yield today. So in rental terms, our 25 million there, you can see shaded, but actually we have a much higher rental value. And that comes through both lettings that we've contracted, but where they're yet to complete because we're carrying out refurbishments or we're getting planning consents. But also we've just got more potential by having market rents that are above our currently received rents. And so that, if you look at the difference between the 24.9 million and the 29.5 million, that's 4.6 million of potential reversion, which is in the context of the dividend that we were paying prior to the postponement of about £16 million a year. Now, we're realistic insofar as we know we won't get all of that because rents are falling, but it is a much bigger buffer than the average for the UK and for our peer group. And also, really importantly, of that 4.6 million, 2 million of it is contracted. So that's where, as I say, we've either got lettings, for example, we've got a letting or two lettings to Lidl, where they've signed new 15-year leases, but where we're not actually receiving the income yet because those are either on rent-free or in the process of completing those works. The last point on this slide on the right-hand side is just provide a bit more of a granular analysis of where we're positioned in the UK market. And the two key points to note here are our overweight position to the rest of the UK office market, so 3 times the weighting, and double the weighting within the industrial sector in the rest of the UK. And I'll expand on that shortly in a moment. So just moving on, briefly touching on the top 10 assets, as I say, we are diversified, but actually we think we've got some really great quality assets, particularly when you're looking within our top 10. I'll come on to 3 more recent examples in a moment, but just to focus on the right-hand side with the images there, we own a really fantastic industrial estate in Milton Keynes. If you own industrial land in Milton Keynes, you will build a big box and you'll pre-let it to an internet retailer or a distributor. What you won't do is build small unit multi-let industrial estates. So there's a restricted supply, and this is an asset which, you know, is a really dominant industrial estate, which all of the specialist industrial companies I'm sure would love to own. So that's a typical example of our industrial estates. And then our single London asset, which we think is a really interesting opportunity, which is where we own a half share alongside another Schroder managed vehicle of a large freehold site in Bloomsbury. So an area which is benefiting from infrastructure investments, where again, I noted earlier on the increased investment in life sciences. We think there's a tremendous opportunity in Bloomsbury, particularly with this asset taking a 5-10 year view to pursue some form of larger scale redevelopment. So moving on to the next slides, last few slides. So this slide is again from our results, which was just aimed to give shareholders an idea of the types of assets that we owned over the period and the asset management we've been doing. Our retail weighting, if you look at our pure retail exposure, it's around 18%. But it's very much focused on value, convenience retail, and what we call value retail warehousing. The asset here on the left-hand side is Bedford, so this is about 28 million of our 70 million retail exposure. And over the period, we completed a letting to Lidl. They're the new anchor of the scheme. That's what the new unit will look like. And whilst this has seen a decline in values, we're now holding that asset off a yield of about 7%. And off that level, we think we'll see, we should see better performance off that valuation. The next two, just briefly, an asset in Edinburgh we own called The Ton. Edinburgh is we absolutely consider to be a winning city. This is an asset which faces off against Holyrood on the one side, so we have the BBC as a tenant, but we also have tech businesses very near us, so Rockstar Games are across the road. Again, focused asset management, and having bought this about 4 years ago, we're now generating a yield on cost of about 7%. Prime Edinburgh yields today are around 5%. And then the last example, again, and this is exactly the sort of asset that some of the specialist REITs raising capital want to own today, is almost a 500,000 square foot industrial estate right on the Leeds Inner Ring Road, where we've got an average rent of about £5.75, where we're already doing deals of around £6.50. So these are good quality assets as part of that balanced portfolio where we think we will see continued performance. So just moving on. The last couple of slides is just that we're getting a lot of questions, understandably, about resilience of income. And we've historically provided shareholders with an analysis showing Dun & Bradstreet ratings, so independent credit ratings, and those are pretty much irrelevant now because it's all in the rearview mirror. And so what we're showing here is our top 20 tenants. which represents about 40% of income, and you can therefore see, by virtue of having 300 plus tenants, just how granular the remaining part of the portfolio is. And by looking down the list, you can see we've got, generally speaking, good quality household names. We do have some retailers, but they are focused on the more convenience end of the market. We do have some hotels, both of whom are fully paid up on rent. We have no Travelodge, and we also have a couple of educational tenants, again, reflecting on the conversation just a moment ago, University of Law, who are a business funded effectively by the London legal firms, and therefore with less reliance on international students, and Buxton University, who actually specialise in nursing. So we believe that they are, that they should be well positioned, particularly in light of COVID. So moving on, just the last slide before I wrap up. This is where we're going to be focusing our money. So as I say, we've got 85 million of cash. Some of that we'll keep back for capital expenditure projects, but we do have 60 to 70 million, which we will look to deploy in the market later in the year. Again, as I said before, that sort of basic approach of worst house on the best street, I think given COVID, we will probably buy more quality than we perhaps might have done, but the absolute priority, unsurprisingly, will be on resilience of income. And I think, we do believe that whilst we are seeing the investment market come back to life, there could well be an opportunity to acquire assets at more discounted prices, not least from the daily price retail funds as they open up. So moving on, just to wrap up before questions, just to summarize, we have delivered really all of our key strategic objectives over the year to March 20 that allowed us to increase the dividend. Clearly, COVID has impacted that with the dividend postponement, but hopefully what's come across is that we have a clear path for getting back to growing net income and reinstating the dividend. The final point I'll note is, as I say, there will be a theme you'll hear today, I'm sure, that COVID has accelerated those big strategic structural trends that we believe we've already been investing in, but we will be evolving the strategy as those trends accelerate over the next few years. So with that, Richard, I'll hand back to you for any questions.
Great. Thank you, Nick. Let's have a look. All right. How do you view the impact of Brexit and the UK trade negotiations, China relations, on the wider prospects for the UK economy and therefore post-pandemic property situation?
Okay, so I think Brexit is something that obviously we've been looking over our shoulder at, if you like, for the last few years, and I think that has, I think without that, the market might have performed better. I think it has been a drag on the market. I think that clearly the type of trade deal we get will have a direct impact on the market, but I think we are more, I think in many respects actually COVID means that the short-term impact will be less significant than perhaps it might have been. We've deliberately avoided financial services businesses in London. The only tenant we have in London is as I say, an educational business, and therefore if we see a Brexit deal that is bad for the City of London, then I think that clearly could have an impact, mitigated by, as I say, the fact that we don't have a huge supply side risk in London. I think from a Chinese perspective, I think we will expect the capital flows from China to global cities, and London being a key beneficiary to, if anything, to continue and strengthen. And indeed, over the last few weeks, there's been a step up, particularly in Hong Kong-based investors looking at central London. So I think Brexit is a risk. We've tried to position for it, but long term, we think the UK will remain fully investable, and actually we may see increased capital flows coming from Asia.
Cool. Next question. How would you persuade a retail investor to invest in a UK specific REIT like yours, rather than in a more geographical diverse one that perhaps includes Europe?
Yeah, so there are means of accessing both, insofar as you can buy something like the Schroder European Real Estate Investment Trust, the sister vehicle to this, which is investing across Europe ex UK. I think if you're investing directly with a strategy like ours, where the focus is very much on a high level of asset management activity on the ground, it's easier to do that as a specialist in the UK. So I think, so I think, you know, the answer probably is you can access the UK better through a vehicle like ours, but there are other means by which you could access the UK, a continental European market.
Okay. I think you touched on this one, but maybe you want to repeat it or expand on it. What are the short-term plans for the £85 million in cash reserves?
Okay, so we've got approximately 15 million that we will be holding back for capital expenditure projects, either projects that are live that we're funding. So I mentioned a couple of Lidls that we're in the process of building, but also projects that are under negotiation. So that's the first thing. And typically where we're investing significant capital in the portfolio, we're trying to do it off the back of pre-let agreements. So we'll agree a pre-let to Lidl for 15 years, and as a condition, we will obviously get on and build it. So that's the first point. The remaining part of it, so the 60 to 70 million, we don't feel under any pressure because of obviously the market uncertainty, but we are looking seriously at a number of opportunities and would hope to get that capital deployed over the course of the next 12 to 18 months. As I say, I think we are expecting there to be more property to buy later in the year, possibly from sellers that really do need to sell, like the daily price funds I mentioned. But we're not going to rush because of the remaining uncertainty.
Is there any specific sectors you're looking at or geographies?
I think we're going to be quite agnostic and will be opportunistic. So I think we will be sticking more to our overarching principles around winning cities, high growth locations, good property fundamentals. I think naturally at the moment we would move more towards offices and industrial, because I think even if we bought the best retail deal in the market, it would do absolutely nothing to our share price rating. I think many shareholders are looking at our rating saying, you've got 18% retail, I know it's below benchmark, but I just don't like retail, I'm not going to buy your shares. And so I think therefore, whilst we will be open-minded to all sectors, I think if we are buying retail income, it's much more likely to be part of a mixed-use asset, where you've got a combination of offices above, perhaps with some retail below, perhaps with a hotel attached, you know, depending upon the outlook for that sector. So I think it's most likely office industrial, but and probably also some mixed use.
Question here on rent collection levels.
Yeah.
What are they looking like for June, and what are your forecasts for future ones, sort of September and onwards?
Okay, so we're approaching 80% for March. Relative to where we were this time last quarter for the June numbers, we're slightly ahead. And we'll be announcing the full stats to the market in a couple of weeks' time with our June NAV. We have a whole raft of either agreeing a 3-month rent holiday in return for that being repaid over a period of time. We have a number of negotiations where actually there's an opportunity to give a tenant some rent free, where we're comfortable with the underlying credit risk, and have that as part of a negotiation where we're either extending lease term or locking in a rent review ahead of time, which we think will be additive to capital value. Looking forward, assuming that we don't see a further extension of the moratorium on forfeiture, the point I mentioned earlier on, which runs until the end of August, I think the September collection rates should be better still, because tenants won't have the ability to withhold under that exemption, but also there'll be an element of catch up as companies begin to collect the rent that they've agreed to be deferred over the previous quarters. That also assumes that we don't see a material step up in tenant delinquency. We don't think we will, because if you look at our portfolio, A, the lower retail weighting, B, the type of tenants that we've got, means that we think we're pretty well placed. But you can see from a broader industry perspective, you know, we are seeing an increasing number of administrations in the retail sector. We're seeing an increasing number of CVAs where retailers are demanding turnover rents, and I think if we see another more serious lockdown, then clearly there'll be an impact there on businesses and potentially vacancies. So we think we're pretty well placed, and I think assuming sort of a central scenario, we would expect it to improve as we move through the year.
Cool. Another one on rents. To what extent are rents in the UK linked to inflation, and does this vary by sector?
Okay, so there's a broader question around, do rents overall track inflation in the UK? And historically, they have been a reasonably good hedge on average, but we have seen that dislocate, particularly more recently in the retail sector. So the structural trends are having an impact, which is what we'd expect on the rents that tenants can afford to pay. So historically there has been a link, but subject to that point around structural change. I guess the next point, which might be another reason for the question, is the extent to which leases themselves actually have mechanisms that allow you to review to either RPI or CPI. And it's still a relatively small part of the market. So obviously that's customer practice within continental Europe. You tend to see it more in the UK, where you've got alternative asset classes where there's not an obvious benchmark when you come to do your rent review. So I don't actually know the answer. I can come back on the point as to exactly what the number is for the UK market, but it's probably 5-10%, and our portfolio is probably slightly below that average.
Okay. And just a question on your development pipeline.
Yeah.
How big is it? What are the plans now after sort of COVID? Have you extended your plans?
Yeah, so we've got about £9 million of either contracted, so where we're actually doing the work currently, or committed, or under consideration projects, where we expect to invest about £9 million. The projects where we are yet to actually formally legal contract, we're continuing to review, and we'll probably go back to that later in the year when there's a bit more visibility on the market. The vast majority of what we're doing, though, is backed by pre-lets. So of the contracted projects we're now doing, as in contracted to build, the majority of those are contracted with pre-let lease agreements in place, like the Lidl I mentioned. So as part of our, it's a relatively small part of the capital that we've got to deploy currently, and the focus is more, as I say, on investing that into new opportunities later in the year.
Cool. All right. That's the end of the questions, and I think we're sort of bang on time there. So thank you, Nick, for your time.
Thank you. Thank you for yours.
Very interesting.
Welcome to the London Metric part of today's presentation. So for those of you who don't know me, I'm Andrew Jones. I'm Chief Executive of London Metric. London Metric was created back in 2013 following the merger between Metric Property and London and Stamford. And since then, we have been increasingly focusing the portfolio around the logistics market, which, as you can see today, accounts for about 70% of our enlarged portfolio. And that is something I'll come on to talk about in a bit more detail. We look at the logistics market three-dimensionally. And the second conviction call that we have today is long income, which again I'll go into talk about in a bit more detail over the course of this the presentation. Our activity over the last few years has not only been in growing our logistics platform, but also increasingly pivoting it towards the urban logistics subsector of the market. And that's something that we've been doing both through corporate acquisitions. It's about a year ago that we completed the acquisition of the A&J Mucklow business for just over £400 million. But we've also been doing it through portfolio acquisitions and also individual what we call rifle shot properties. Urban logistics has had a terrific run, and if I'm allowed to say this, has had a pretty good COVID period as the UK consumer continues to move its shopping patterns from physical retailing to online. And again, I'll come back to talk about the market and demand and supply dynamics later on in the presentation. Today, online penetration for retailing is over 33%. Back in February of this year, it would have been just under 20. And 10 years ago, it was actually back down at 7%. So we've seen a massive shift in consumer shopping online. And the best way to play that, in our opinion, from a real estate perspective, is to look at the warehouse sector, the distribution sector, but particularly more recently for us, it's been the urban logistics, as consumer expectations seem to grow higher and higher every single day. I read an interview with Jeff Bezos, just to digress slowly, recently, and it said Jeff was asked what he thought would change over the next few years, and he said, "Well, it's easy to actually talk about what's not going to change over the next couple of years. My customers are not going to write to me and say, Jeff, I wish you'd charge me more for the goods that we buy from you." The second thing is, they're not going to write to me and say, I think I'd like you to deliver the goods a bit slowly. So the fact of the matter is that consumer expectations continue to grow every day, and hence why our tilt more recently into the urban logistics space and away from the mega sheds. Our push into long income is essentially underpinned by what we define as a global search for yield. Demographic shifts continue to intensify. Zero interest rates today are such that, I think well let, long let, structurally supported real estate is a terrific income compounding investment that will, that is far superior to and offers far superior yield to what you can get in most other forms of investment medium. And that's what has underpinned our push into long income. Long income today accounts for about 24% of our portfolio. And that's predominantly split again across the convenience food sector. We announced recently the acquisition of 5 sale and leaseback transaction with Waitrose, but we're also a big landlord to Lidl and Aldi and Marks and Spencer Simply Food. It also covers what we call low energy retail. We have big positions with the discounters, the B&Ms, the Home Bargains, and the Range. And then we have DIY and trade. The rest of that portfolio. Overall, we run London Metric as what I call with an ownership culture. The management team founded the business. We have big shareholders in it. We are internally managed, and we are shareholders first, and we are employees second. And that allows us to make rational decisions. And we have a saying internally. We say, when we're looking at an asset, if in doubt, we leave it out. We don't buy assets just to increase our fees under management or assets under management, so our management fees will rise. At the end of the day, we're eating our own cooking. So for us, our investments have to be rational. We're looking to put it into assets that we think are fit for purpose, well located, and are going to be a benefit of the structural shifts that we see taking place in the wider macroeconomic world. For me, that is a global search for income and an increasing online penetration from the UK consumer. And like I said, the need for quicker and more efficient deliveries out of what we believe are well-located logistics distribution warehouses. So if we go to the next slide, I've touched on some of this already, but the fact of the matter is, online retailing is growing, and the longer we've suffered this lockdown, the more embedded these new habits are becoming. I talked about what's happened to online penetration in retail. Probably the biggest increase in online penetration has actually been in the grocery sector. It took 12 years for online grocery shopping to reach 7%. It's taken 12 weeks for it to double to nearly 14%. And a lot of the people who are now using online grocery shopping are doing it very much for the first time. I think Tesco announced that they're now making over 1 million deliveries every single week, and off their Tesco.com platform. And we think that that is continuing to grow. And whilst the tectonic plates in online may come back a bit, they're not going to go back to where they were pre the pandemic lockdown. So we think that warehousing is the structural, the right side of the structural shift, and we will continue to allocate more and more of our shareholders' money towards that. I think that, you know, complementing that online is our focus around convenience, which we play through the long income portfolio. And like I said, that's underscored, you know, our recent investment into Waitrose assets, but also people like, you know, M&S, Simply Food, Aldi, Lidl. You know, I can see the convenience, the top-up shopping becoming more embedded into the normal shopping habits. And I think that comes at a cost to what I call, you know, big supermarket shopping, or indeed, you know, big experimental shopping centre visits. I think there's going to be a shift towards more convenience and more local shopping alongside your online purchases. I think when we look at what's happened over the last 14, 15 weeks that we've had to endure in lockdown, is, you know, retail has delivered a polarized performance. Like I said, I think convenience food has been a winner, but there have also been some other strong performances. You know, the discounters have all done very, very well. The pet shops have done well. The DIY retailers have had a pretty good lockdown period. The biggest losers have obviously been the department stores and a number of the fashion stores who had to, you know, as I think Simon Wilson that said, you know, you don't have to buy a new dress if you're going to stay at home all day. So there has been a massive polarizer performance. And then also you've got the electrical retailers have done pretty well. And obviously Halfords announced recently, you know, a massive increase in the amount of sales that they've been doing online during the lockdown process, as anybody who's been looking to buy a bike can vouch for. So I think that polarization will continue. I think that the gap between the winners and losers will widen. And I think what we said in our annual report recently was, you know, the losers are being unmasked, and the winners will find out that their margin of victory is likely to be greater. So I think that being on the right side of that structural shift is how we positioned our portfolio. So just turning on then, Richard, if you may just flick on to the next slide. We think that we like all logistics. You know, we like the big boxes, we like regional, we like urban. But the truth of the matter is, we just like the urban a bit more than we like the others. You know, this is a for us, this is a tilt within the logistics sector towards urban and away from mega. We think the demand and supply dynamics for urban are superior. It doesn't make mega investments poor, it just makes urban better. So our allocation of capital is very much skewed towards that smaller, well-located warehouse in close proximity to where most of the urban population live. Because it's all about delivery times, it's all about efficiencies in order to be a winner in an omni-channel world. Physical retailing, as I said, it has been a polarized performance. I think that we are finding out that a number of assets are overvalued, overspaced, and I think that they're going to find, you know, that footfall and customer visits are going to be lower going forward than they were, and they're going to find, as a number of retailers are already commenting, that actually the rents that they are paying were set in what I define as a bygone era, and therefore I can see footfall falling, I can see credits weakening, I can see obsolescence growing, I can see leases shortening, I can see rents falling, and I can see yields for some of these big centres expanding by a material amount. I think that by and large, most retailers that I can think about are overspaced, and so therefore that you will see over the next few years retailers looking to continue to right-size their platform as they try to improve their omni-channel proposition. But like I said, I don't think that you can paint retail with the same brush. I think there are parts of retailing that are finding it very tough, but I do think there are certain subsectors, and I focus really on convenience food and discounting, that actually are performing pretty well. And I think that you know, for us, you know, we don't own any shopping centres. Our retail park exposure has been cut dramatically to to less than 5% of our portfolio today. But I do think that you have to look at retailing much more forensically today than you might have done 5 or obviously 10 years ago. And I think that having a deep experience in the retail property market has certainly helped us, navigate some of those stormy waters over the last few years. So, turning then to the next slide. So our portfolio, our logistics portfolio, which I said makes up 70% of the £2.4 billion that we currently own. We split it, as I say, into 3 segments. We have urban, we have regional, we have mega. Biggest part of the portfolio, surprisingly, given what I've already said, is the urban logistics part of the portfolio. That is nearly doubled in the last 12 months, predominantly through the acquisition of the A&J Mucklow business, but also, as I said, through subsequent alternate portfolio purchases and also some individual asset acquisitions. We enjoy superior rental growth. You can see there in the bottom grey box that we've coloured. Rent reviews have by and large been coming through at roughly 5% per annum rental growth, which is I think probably the highest organic rental growth that you're seeing across the entire real estate sector today. Our regional and mega distribution makes up about a third of our portfolio, and again, still growth, so still positive, still demand, full occupancy, but the growth is just a bit less than it is in the small boxes. So, when we're having our competition for capital, not surprisingly, if there are 2 opportunities for it to invest in, we're going to invest in the one that we think is going to give us the superior growth. And then long income makes up, as I said already, 24% of the portfolio, dominated by convenience food, but also the discounters and the trade and DIY retailers. Again, enjoys full occupancy, long income, and most of the rental growth that we've seen over the period in that sector would have come from our contractual uplifts, which are the majority of which will be linked to either RPI or CPI. Probably one other point worth making is as you can see the logos that we've highlighted there at the bottom is one of the focuses that we also consider is improving the granularity of our income. This time last year, our top 10 occupiers accounted for just over 50% of our rent roll. Today, our top 10 occupiers only account for just over 35% of our rent roll. So improving the granularity of our income is also one of our KPIs. Turning, Richard, if I may, to the next slide. So I've already mentioned that the vast majority of the investment activity over the last 12 months was dominated by the acquisition of the Mucklow business, which substantially increased our urban logistics portfolio. But we've also acquired, regional distribution, and also, as you can see there, some long income. As I mentioned earlier, the most recent was the £62 million acquisition of 5 Waitrose stores via a 20-year sale and leaseback. And one of the attractions of the Waitrose business is that it works as fulfillment. Those stores also work as fulfillment centres, both for Waitrose.com, but also for John Lewis as well. Most of the disposal activity has been reducing our mega warehouse footprint. We've recently sold Dixon's Carphone Warehouse, Next Warehouse in Doncaster. But we've also taken some money off the table by selling the DFS headquarters in Doncaster and a Royal Mail facility in Rotherham. But post the integration of the Mucklow business, there's obviously a number of assets that we acquired as part of the business that we consider to be non-core, notably 2 offices that we sold, also a car dealership that we announced the disposal of recently, and we'll continue to sell down of those non-core assets over the course of this year, which will obviously free up money for further investment into our 2 conviction calls. So this is just a breakdown of some of the acquisitions that we've announced recently. As I said, 62 million invested in 5 Waitrose sale and leasebacks. And as I said, not only are they long let, but also I think the fact that they are used as fulfillment centres, both for the 2 online businesses, was particularly attractive to us. We also acquired an Ocado last mile warehouse in London. which is let for a further 8 years, and we believe to be highly reversionary. But also, and that's indicative of the sort of assets that we would like to continue to acquire. Well let, great business, structurally supported sector in a great geography. But not surprisingly, these are well sought after, and so we have to work very, very hard to unlock those sort of opportunities. And then in our most recent acquisition in our long income business has been the acquisition of 5 London quick fit auto centres, which we acquired via a sale and lease back from Quick Fit on 15-year leases. And again, very well located. As I said to somebody the other day, electric vehicles will undoubtedly continue to dominate our purchasing patterns going forward. But to the best of my knowledge, they're still going to need tyres and they're still going to need brakes. So we believe that the auto centre market is relatively well supported. But this acquisition was also underpinned by the geography, the intrinsic value in the land. Of buying these sort of assets around London will give us some optionality in the future when these leases come to an end. So the next slide. So this is really just my thoughts on, or our thoughts on, the market outlook. We think that, without a doubt, a number of the trends that we're seeing, as a result of COVID-19 and the 14 or 15 or 16-week lockdown that we've all had to endure, we think that what that is doing really is accelerating a number of trends that were already in the system. The growth of online penetration, as I said, has gone from 7% to 19% over the last 10 years, but it's gone from 19% to 33% in the effectively just over in the last 12 weeks or so. We think that the lockdown has accelerated that trend, and like I said, we may see that 33% tail off as life returns to some form of normality, but we don't expect it to drop back down to 19%. And I think that a number of these temporary trends will become increasingly permanent. And the one I think that will see the most dramatic change, as I said before, is the permanent increase in online grocery shopping. This market is not only is it exposing and unmasking losing strategies, it is also highlighting winning strategies. I would also go so far as to say that it's also a number of safe haven sectors. And what I mean by hotels or offices, student or hospitality and food and beverage, a lot of those sectors that were considered to be safe havens today probably feel a bit more vulnerable than they did pre-COVID lockdown. And I think that's a more difficult market to assess. It's obviously too early to talk about the death of the office, but the fact that people are writing about it, makes it, somebody said this morning, the same way we were talking about the future of retail 4 or 5 years ago, we're talking about the future of the office. And the fact that it's on the agenda makes it a more vulnerable sector in my mind. So the market is polarizing. The sectors are polarizing like they've never polarized before. And that's very apparent if you look at the valuations of in the equity markets between the winning sectors and the losing sectors. And I think that I don't see that changing, despite the perceived big discounts that a number of retail businesses, retail companies are trading on. There's good reason to believe that the equity market is more right than the property market, and that the V will simply continue to drop down until it reaches, the sort of equity price that the markets are putting on it, on some of those businesses. I think the macro environment with zero interest rates is also very favourable, as I said earlier, for the well-let, structurally supported real estate let for long periods of time to good credits. And I think that, when you look at what 10-year gilts are trading at, or what index-linked gilts are trading at, you've got 10-year gilts at about 0.2, 0.3. And you've got index-linked gilts trading at negative 2.5. And so when you think about that compared to the 4.35, 4.4% we paid for 20 years of Waitrose, albeit with a break at 15, it does make some of those long income, low energy assets and structurally supported sectors look increasingly cheap. And that's why that a number of long income assets and sectors are part of our conviction call. So on the next slide. So looking forward, I think, history will show that the post-pandemic world has changed in many respects. As I said before, the tectonic plates have shifted, and they may shift a bit too far, but they're never going back to where they were. And I think that the trajectory and the speed of the recovery is unclear, but we think that trends that were already in the system are just going to simply accelerate much quicker. I think aligning our portfolio to the logistics and distribution sectors together with long income puts us on the right side of those structural changes. And I think that we've been incredibly disciplined in how we've built this portfolio up over the last 7 years since our merger. We'll continue to focus on reliable, repetitive and growing income, and that's what will support our well-covered progressive dividend. We announced that our dividend for the last financial year, continued our progressive policy, and our quarterly dividend that we're due to announce next month is expected to support that as well. And I think that at the end of the day, income, as soon as the income comes in, we think the duty of a REIT is to pass it through to the shareholders as quickly as possible. Over the last couple of months, since lockdown, we've continued to strengthen our balance sheet. We've not only improved our debt capabilities in terms of increased facilities and longer facilities, but also we raised 120 million pounds worth of new equity via a cash box, and I think that we will continue to look to deploy that. We've allocated, I think, roughly just over 90 million pounds worth of that through the Waitrose, Ocado, and QuotedData's acquisitions, and we'll announce a further acquisition over the coming weeks. And we will continue to use that balance sheet to look at capturing quality opportunities that rarely find themselves available in a normalised market. And it's no coincidence that the vast majority of the acquisitions that we're seeing at the moment that interest us are sale and leasebacks, which we expect to receive to become available in a normalised investment market. So if that's all actually I had to say actually until we go and which I'm sure you've got some questions that you might want to open up.
Yes, I do. Thank you, Andrew. Let's go to the questions. To what extent are leases and rentals linked to inflation in the UK logistics and retail sector?
So I'm just moving actually. Can you hear me, Richard?
Yes, I can, yeah.
Hello?
I can hear you. Can you hear me?
Hello?
Can you hear me?
Hello? Hi, Richard.
It's a bit echoey.
Okay, hold on a minute. Can you hear me?
Yeah, I can now, yeah.
Sorry. Look, so logistics, in mega distribution, you'd expect inflation-linked rent reviews to cover the vast majority of that market. In urban, it's much more open market rent reviews. And in regional, I would say it's probably a combination of the two. In retail, it varies again. Traditionally, all retail would have been open market rent reviews, with the exception of the grocery sector. I think that probably holds true today, with a possible exception that we've seen a bit more RPI, CPI rent reviews in the discount and DIY sector over the last few years.
Okay. Next question. To what extent is online grocery shopping growth going to diminish the space required by existing large supermarkets for physical shopping?
Yeah, that's a good question. Yeah, that's a good question. Yeah, I think that's a good question. I think that when I think about shopping habits going forward, I think about online grocery penetration doubling, and I think about convenience. I think the 80, 90, 100,000 square foot supermarket looks grossly overspaced. And whilst I think that the operators for now will use the surplus space as fulfillment centres, they are paying a very high rent on effectively what is warehouse space, not showroom space. And so I think you're going to end up with either a right sizing of that footprint, or you're going to get a right renting. And the right renting could look like, well, the 60,000 square foot we're using as a showroom, we'll happily pay £20 a foot for. But the 30 or 40,000 square feet that we're using as a fulfillment centre, we only want to pay £5 a foot for. So I think that those footprints, it's either the footprint is too big or the rent is too high, or possibly a combination of both.
Okay. Well, got a question here regarding your portfolio split.
Yeah.
So going forward, how big do you think long income will become relative to your logistics?
I think long income will stay around about 25%.
Okay.
I think it's tactical. You know, we'll you know, when you know, yields will continue to compress, we think in long income, and we'll take the opportunity probably of taking some chips off the table. But it'll be about, you know, we don't see it. It doesn't need to grow much higher than where it is.
And following on from your previous comment about the sizes of stuff, what was your rationale then behind the Waitrose sale and leaseback?
Yeah, so those are much smaller sizes. So those are much smaller assets. In fact, if you go back a couple of slides on the presentation to the recent investment activity, yeah, keep going. Yeah, there we go. No, yeah. So as you see, they actually only range from 27 to 43,000 square feet. You know, a typical Tesco's would be at least double that. You know, they'd be talking about 75, 80,000 square feet. And also for us, what was also important was to make sure that we weren't buying them at an over-rented, you know, the rent was not too high. We were conscious that we wanted to keep the rents low. We think it's reversionary day one. And I think that one of the things you'll understand when you put, you know, many years of compounding inflation on some of these rents is that some of them, you know, once they get into the 20s, they start to look pretty full, particularly on big floor plate, you know, big footprints.
Okay. I think you touched on this about the 120 million pound capital raise. When do you expect to, or how much have you deployed so far, and when do you? So,
well, at the bottom of this slide, you can see there, including the deal we've got, another deal I alluded to, with just over 90, I think it's 91 million we've allocated of it, but we don't look at it like that. We're not in a hurry. You know, we're making sales at the same time. So look, it'll be, we put a lot of, the vast majority of it is being put to work very quickly. The truth of the matter is we wouldn't have raised the money if we didn't have the deals in hand. You know, we rarely look to come to the equity markets. So, you know, we only came because we were seeing deals of a quality that were rarely available in a normalized investment market through the sale and leaseback process. You know, what you've seen during this lockdown is quite an interesting behavior by occupiers. You know, as obviously their revenues have collapsed, they've been trying to shore up their balance sheets. And you've seen certain retailers and occupiers go to the stock market to raise money. Some have gone to the debt markets and you know, negotiated extensions and waivers with their lenders. And others have looked towards their own property assets to try and raise money. You know, you look at Waitrose, John Lewis, you look at Quick Fit, you look at the Next, who've done 3 sale and leasebacks across their portfolio. So there are various tools available to these businesses to raise money, and you know, it's not for me to tell them which is the right one, but as we started to see sale and leasebacks becoming a potential opportunity, we wanted to make sure we had sufficient firepower. And our equity raise was unbelievably well supported. You know, we could have taken a lot more money, but you know, that would have put us in a difficult position, because we would have then become a forced buyer rather than a smart investor.
Yeah. So are the future announcements on acquisitions going to be sale and leasebacks, or are they, what type of sector are they in?
They're in convenience. They're in convenience food.
Cool. We've got a question here on the property sector in general. What's the nightmare scenario for the property sector?
Well, let me just start with the property subsectors first. I mean, you know, I'd say that physical retail feels like it's on a perfect storm at the moment, and they probably would say, well, we're already in that nightmare scenario, which is, say, weakening credits, falling rents, increasing obsolescence. So retail has already got a perfect storm, I'm afraid, and I don't really see a way out of that that ends happily. I think in the other sectors, I said there's a number of previous what I call safe havens, which are looking more vulnerable today than they did. And I'm not an expert in offices, but I'm probably glad I'm not. And then we talk about hotels and hospitality and leisure and whatever. So that sector feels more those sectors feel more vulnerable tomorrow than they did yesterday. I think in logistics, people talk about, well, what happens if they put an online tax on you, or there's a rating revaluation. I think that I think habits are changing, and I don't see a huge amount on the horizon that concerns me about urban logistics in particular. Particularly is, by its very name, it's supported by an intrinsic land value, which is undoubtedly going to be higher than its than its current use value. So I don't see too many clouds on the horizon for urban logistics. Mega box, the nightmare scenario is a supply response to the demand. We get a lot of speculative buildings. I think the first time you and I met was I think I was negotiating to buy some land in Bedford. And we're still thinking about whether or not we were, when do we start building out the final phase of that? And I think that must have been Richard? That must have been 5 years ago, is it, or 6 years ago?
6, I think 2014. Yeah.
14, yeah. So the scenario, the nightmare scenario, I think for mega is a supply response. I think that the nightmare scenario for the industry as a whole would be something around the REIT rules. If the government was to change the rules on REITs and obviously the great thing for us about a REIT is that we're able to pass our rental income from our tenants to our shareholders without the friction of double taxation. And obviously that's something that we embrace enormously. We believe that income compounding is one of the great wonders of the world. And so if the government was to introduce some legislation that affected that, then that wouldn't be great. But I'll be honest with you, I've not heard any chatter around it anyway. So.
Okay. All right, we've got another question here on what you've already touched on online tax. What impact do you think that will have on the logistics sector?
I don't see. I mean, obviously, it depends on what level it comes in. But I mean, I think there's a danger that you're starting to tax people's choices. And I think that's dangerous. If you go back to the history of retailing in the United Kingdom, in particular, back in the 60s, traditional retailing in the UK was dominated around high streets. Back in the 60s and 70s, we started to see the evolution of the shopping centre concept. During the 70s and 80s, we started to see the supermarkets rise, and initially in town, and then more latterly through the 80s and 90s to move out of town. And then, when we got into the noughties, we saw the birth of what we called the shopping parkers and the big shopping centres, out of town shopping parks, where retailers demanded, more efficient floor plates, bigger floor plates than was traditionally available in town centre locations. And now we're seeing retailing habits migrate towards an online. I mean, it's every 10 or 20 years there seems to be a big shift in retail shopping patterns and habits. And so, this is part of that natural evolution. And I've no doubt in 10 or 20 years' time that there might be something else that comes up. But I think trying to tax this evolution and trying to put the genie back in the bottle, I think is dangerous. I mean, the one thing I'm absolutely certain about, and this goes back to that interview that I cited earlier with Jeff Bezos. The fact of the matter is the retailers are going to get better and more efficient with their omni-channel model, which is going to bring down the costs, to the consumer. And if it means that additional convenience, we have to pay for it, as we do, by the way, with a number of retailers. If you want same day delivery or next day delivery with certain retailers, you pay for it. If you want a 4 or 5 day delivery, then it's free. So I think I don't see a massive disruption from a tax caveated by, I have no idea what the size of that tax charge might be.
Question on yields. Are investment yields in logistics getting too hot now?
Well, that's an interesting question, but unfortunately, it's the wrong question. Because yields are supposed to reflect the time, the amount, the security with which your initial investment is returned to you. So yields have to be stapled into the same question or same conversation as what you think is happening to rental growth. I think a 4% yield on an Arcado facility in Walthamstow that I think is 25% reversionary is cheap. I think a 4.5% yield on a mega warehouse in Scotland, where I think it's already over rented because of the indexation mechanisms, is expensive. So we can't look at yields one dimensionally. They have to be looked three dimensionally. So we have to think about, you know, the quality of the income, the length of the income, and the inherent growth that's coming out of that particular asset. So it's it's dangerous just to say, oh, logistics looks expensive. I don't think 4% is expensive if rents are growing at 5% per annum. In fact, I don't think it's expensive if rents are growing at 3% per annum. But I think 4.5% or 5% is expensive if rents are over rented.
Yeah.
You have to triangulate this. It's not as simple. And people will make the same mistakes, I'm afraid. Some people will just go, oh, we've got to buy logistics. They're all great. Not all logistics assets are great. I can assure you of that.
Last question here on Chinese/Hong Kong money coming into UK property sector. Has that grown? And maybe if you've just got a view on the logistics sector. I know we saw a lot of Asian money coming in the last couple of years. Is that still there? Is that going to grow, do you think?
Yeah, you would have thought it would grow. I mean, I can't tell you how far I think it'll grow, but you'd expect more money to come out of Asia than less, for reasons that we all know. I mean, from our own personal perspective, I look at the type of buyers that we've been selling some of our buildings to. You know, Dixon's Carphone Warehouse, you know, that was an £81 million sale to an American REIT, long income REIT. The DFS headquarters and the next mega shed up in Doncaster was sold to Singaporean investors. So one of the things I would say about the logistics market is it attracts global money much more than the retail sector does. You know, retail sector historically in the UK has been very much domiciled with domestic, you know, or dominated by domestic buyers, whereas the logistics market feels much more global. And look, you know, I mean, our challenge today in logistics is not finding a buyer. Ours is finding an opportunity.
Yeah.
I have no issue. My issue is not telling the guys, you know, oh, we should sell a bit more. Ours is a bit like, well, where would we deploy the money if we did get the super knockout price? But that's what we're paid to do. And I think being internally managed means that we're always willing to sell. We're always willing to take the portfolio size down because we're not remunerated on assets under management, unlike many of our competitors.
Cool. Yeah, makes sense. Okay, there's no more questions, and I think we're just about on time. So just
great
for your time, Andrew.
Okay, well, thank you, and stay safe.
Yeah,
keep well.
All the best.
Take care. Bye-bye.
Well, thanks for hosting. Good morning, everyone. I really appreciate you taking the time to join us this morning. My name is Colin Godfrey. I'm CEO of Tritax Big Box REIT. I'll be joined in the presentation this morning by Frankie Whitehead, our RFD. We're aiming to give you a quick 20-minute presentation followed by questions. This opening slide is for those who don't really know us particularly well. We're now about 6.5 years old, following IPO in December 13. We focus only on UK logistics assets. By floor area, we own and manage the UK's largest logistics portfolio with 58 investment assets with a value of a little under £4 billion as at the end of 2019. We also own and control the largest land bank in the UK for logistics focused property, and has the capability of delivering over 40 million square feet. Very attractive and long average lease length in our portfolio of over 14 years, with rents underpinned by a very attractive and strong tenant register. We also have very strong structural drivers in our market, which you'll be well aware of by now, I'm sure, and that is kept the UK going during COVID, with logistics playing a very key role. But this is also a worldwide phenomenon as well, across the globe for logistics, and I think we'll see a continued level of interest in UK logistics from overseas investors, but also from UK institutions that will be looking to reweight their portfolios away from some other sectors, and in favour of logistics. Finally, just on this section here, resilient performance in our rent collection, which frankly we'll touch on a little later. And just looking back over our track record, well, I think we've delivered a strong performance in terms of value growth, the compound annual growth rate being over 7% since 2014, and also strong dividend growth, with a 11% compound annual growth rate over the same period. If you could turn the slide, please, Richard. Thank you. So structurally, what's happening in the market and how we're performing? Well, if we look at where we've come from, obviously e-commerce has had a profound effect on the growth of our sector, but also as has the demand from companies that are looking to operate from larger, more efficient buildings that can give them economies of scale benefits and cost savings. And this is something you will see Amazon doing, really looking at the cost per unit of scale, absolutely crucial component part of that. And a lot of occupiers are now looking at their model and to some degree emulating that. That's been having a profound effect. We're seeing that coming through in the demand for logistics. And you see in the middle slide there, one of the things we've noted, if you look at take-up, i.e. lettings, and you combine that with the amount of buildings under offer at the year end, you'll note there's been a significant increase in demand for larger scale logistics buildings of over 500,000 square feet. Notably, however, actually a slight reduction in smaller scale logistics buildings. Now, we do offer as a house logistics buildings right the way across the size categories, particularly now following our acquisition of the Symmetry business, but we do have a larger weighting towards larger scale buildings. Combined against this very strong tenant demand we're seeing coming through, and I think sustained high quality rental growth in our sector for the long term, we're also seeing quite constrained supply. That partly comes across as a consequence of the way that the planning system works in the UK. You can't just create planning overnight. But if you look at this slide on the right hand side, you'll see that there has been a slight uptick in the speculative supply of smaller scale buildings. And in the bubble there, you'll note the number of months, so 10.6 months worth of supply for the smaller scale logistics buildings against a 12-month run rate of take-up, i.e. lettings. Whereas for the larger scale buildings of over 500,000 square feet, there's only 1.4 months worth of supply against 12 months of take-up. Now, what does all this mean in terms of supply and demand? Well, we've gone into COVID. We saw that online as a total percentage of total retail sales in the UK was around 90% prior to COVID. What is it now? We don't know. There are all sorts of statistics, but some parties are suggesting it's 50% plus non-food. Undoubtedly, the dust will settle and that level will come off. How far will it come off? If you talk to the psychologists, they'll tell you that habit-forming principles apply over it after only a few weeks, and we've been in lockdown for a lot longer than that. So the expectation is that we'll see a substantial increase. If we stabilise post-COVID at around 30% of online penetration, then that will mean that we will increase the level of online sales by 50% almost overnight. But it could be, of course, be higher. It could be 50% levels of penetration. And you'll see what this means in terms of the look-through. Very broadly, for every 1 billion spent online, extra 1 billion spent online, it requires something like 900,000 to 1 million square feet of extra space. You interpolate that to get to the figures down there on the left-hand side. And that could mean, for instance, we would need, somewhere in the order of another 100+ million square feet of logistics in the UK in relatively near term, which of course won't be immediately available, and that will give rise to significant increase in pent-up demand. Richard, if you could turn the slide, thank you. So as a business, we have 89% of our income in high quality investment product. You'll see that shown there. Foundation assets being the longer leased, higher quality buildings with the best quality tenants comprising 71% of our income. But the key thing is there that we've got nearly 90% of our business invested in high quality income producing investments, which will underpin the quality of our dividend and obviously give us ambition for dividend growth. But we also have the ability to add a bit of spice to give a capital kicker and enhance our total return. And that is delivered partly from asset management in our existing portfolio and our ability to rotate assets. And we are intending to sell some investments this year and in 2021, and we're ongoing with that project right now. We're receiving some very attractive off-market offers. But we also look to our development platform, our land platform, and we can see here that 8% of our GAV is invested in Tritax Symmetry, has the potential to more than double the size of our current platform. It's the largest UK strategic portfolio. We're targeting a yield on cost of 7 to 8%, and compare that against our average portfolio yield right now, which is around 4.5%. That's a pretty attractive, accretive position to be in, selling investments at 4.5% and investing that into brand new developed buildings, which we expect to achieve high quality investments and quality tenants from, with decent long-term leases at an attractive yield on cost of 7 to 8%. And so that's the new portfolio of our future, if you like. Now, the first segue into the land platform was Littlebrook Dartford, and which we acquired 3 years ago for £65 million. We've now all in invested a little under £1 million per acre. There are sites in London now, and more recently they've sold for up to £7 million per acre. So we bought very, very well there. We bided our time. We were very patient for technical reasons we're going to now, but we've just announced very recently the planning consent and a market-leading pre-let for a new 2.3 million square foot building let to Amazon. It's Europe's largest industrial logistics building of its type, and it will deliver to us a very significant increase in rent at an attractive yield on cost of 6% plus and a profit on cost of 30% plus. And that's really an indication of what we're looking to do within the Symmetry portfolio longer term, on primarily a pre-let basis, and therefore de-risking largely the development process. Next slide, please, Richard. But looking back at our high-quality investment portfolio again, very quickly, just to say, look, we are primarily invested in different types of building sizes. You'll see 41% in the very large buildings. We think that they're really important in terms of flexibility, particularly in context of social distancing with COVID, automation, etc., which Frankie will touch on later. Our buildings are very modern. 93% of our buildings have been built since the millennium. That's crucial to underpin resilience, reletting availability, and attraction for modern occupiers. There's a slight rounding error there, by the way, and I think you'll find at the peak. High-level automation. We have the most automated portfolio in the UK. Again, that's really important for the future, we believe. Long-term income, 62% of our income over 10 years in duration. But of course, we've also got 38% providing the opportunity of delivering a near-term value creation through lease extensions and lease renewals. Rent reviews, good balance there between open market and RPI indexation, RPI being the larger component part of our income as against CPI. We've done that purposely to increase the reliability of our income, which Frankie will touch on later, and a really good a geographic diversification across the UK, you'll see on the right-hand bottom there. Next slide, please, Richard. Looking at our tenant base, 40 customers across 58 assets. We've resisted an increased level of exposure to fashion retail over the course of the last 6 years. We could have done a lot more deals in that space, and we chose not to. And that is, you know, a relatively small part of our income now at 7.3%. But you'll note we've got some strong tenants in that sector as well, namely Next and TK Maxx. But the areas that we focused on more particularly, and this is no coincidence, is growing our exposure to online, over 20% of our rents as at the year end, maintaining and growing our exposure to food, nearly 18%, and also homewares and DIY at nearly 10%. Now, they are the sectors that have performed very strongly during COVID, of course, particularly online retail as a consequence of the automation, etc., in there, and of course the increase in food sales you've seen. And there is a natural spillover there into the 3PL distribution space, which has also been benefiting as a consequence of COVID. But of course, we've also got other very strong tenants in there, and names that you will know, such as Unilever, L'Oreal, Kellogg's, etc., which have been performing strongly as a consequence or during the COVID pandemic. I think the last thing to mention, you'll see our top 5 customers on the right-hand side. Amazon now actually is 19.1% of our rents following the letting we've just done at Littlebrook at our site inside the M25. I'll now hand over to Frankie, who can talk you through a rent collection.
Hello there, can everyone hear me? Great. Okay. So from an operational perspective, all of our buildings have remained operational through the COVID pandemic. I think we soon realised directly from the tenants the importance of the building and their critical nature. Obviously, e-commerce sales have vastly increased, and our buildings in the main support a lot of that through our customers. And thirdly, they had the capacity to. So larger buildings naturally lend themselves to easier social distancing, and maybe less obvious is the automation factor. So a lot of our buildings have high levels of automation, and again, that's less person-to-person contact. So they're able to remain highly efficient during these times. In respect of the rent collection, that has translated into very strong rent collection stats. As the charts show, for Q2, we have received 96% of our rents. We're expecting a further 1% imminently, and there are 3% where we have payment plans in place to recover that rent over the course of the rest of this year and into next. Moving on to Q3, we made an announcement this morning. The performance is very comparable to Q2, in fact slightly better. By the end of the quarter, we expect to be at a 97% collection rate, with again 3% under discussions and due to be collected during the remainder of this year and into 2021. The key things for us is there's been no rent freeze or rent holidays awarded. The 3% in both quarters, the discussions are all around rent deferral and clawing some of that back over the coming months ahead. Next slide, please, Richard. Thank you. In respect of our leases, the structure of the leases is very favourable. They're all FRI or triple net. The portfolio currently has a 98% occupancy, and in respect of rent reviews, they're typically 5-yearly. There's a blend of rent review type between open market, indexation or fixed. Broadly, 2/3 of the portfolio is indexed or fixed in terms of the rent increases, with the balancing third being open market. 56% of the portfolio does, however, have a guaranteed uplift embedded within the review provisions. So that is either a fixed amount or a collared amount. And as the chart on the left-hand side shows, that's the ability we have to capture that income growth through the next 3 years. Broadly, 20% of our portfolio is subject to review this year with no open market reviews. There's an increase next year up to 40% and 30% appearing in 2022. What the right-hand chart does is try to demonstrate the guaranteed and an estimate of where our rent review growth is likely to come from. So typically we've been performing at the 2 to 2.25% like for like annual growth per annum in respect to the last few years. The dotted line plotted shows the embedded growth through the guaranteed uplifts. So this is either the fixed uplifts or those uplifts with collars. And what that translates to over the next 3 years is a 1.55% annual growth rate. Essentially that is guaranteed, that is mechanical within the leases, subject to obviously the tenants remaining in place. And the dark blue line is us plotting a reasonable expectations of where we could get to, noting these charts were produced pre-COVID and therefore assumptions around inflation were at the 2% marker. But if that were to come to pass, that would translate into a 2.75% annualized growth rate through our embedded rent reviews. Next slide, please, Rich. Thank you. So briefly onto our debt profile. What's been important over the last few months is the fact that we have no near-term debt expiries. As you can see there, the first material expiry appears in 2024. You may also have picked up from our release this morning that there's 2 RCFs in the 2024 column. The top one, the lighter blue bar, the 200 million facility has been knocked out by 12 months. As of this morning, we announced that into 2025. So we've de-risked the maturity risk around the 2024 calendar year. Our debt is long dated, as you can see. We've got a diverse pool of lenders. We have a modest LTV, last announced at 30%. We have an attractive cost of debt, all in at 2.7% broadly, and over a 7-year unexpired term. We've got access to the public bond markets. We recently executed a private placement deal with some US investors, and we've got a plethora of revolving credit facilities that will allow us to invest through the development pipeline and recycle our capital. I think it's back to Colin for the last slide. Thank you, Richard.
Conscious of time, just to wrap up here, that I think it's important to say that we're incredibly positive about our sector and the opportunities that the next few years will undoubtedly provide to us. Really with a backdrop of a very strong fundamentals in our market, high quality customer base, that resilient growing income in our portfolio, sustainable growth in the development pipeline, which will undoubtedly enhance our total return prospects, and the disciplined capital allocation that Frankie just touched on. I'm happy now to open the floor to questions. I don't know how you deal with that, Richard.
Yeah, we should have a few come through. Let me just get them up. So I think this one's on your Littlebrook scheme and the recent letting, but also sort of market-wide as well, I suppose. How much rent is charged on the mezzanine levels? Is it the same or is it discounted to the ground floor?
Yeah, it's a good point. So multi-decked structural mezzanine buildings, and they do cost quite a lot more money to put in a structural mezzanine, are clearly more expensive. That is seen in the build cost. But there are clearly benefits of utilising the volume in taller buildings, and we have seen buildings increase in height. The buildings at Littlebrook are approximately 20 metres high, but we have seen over 25 and up to 30 metres in the UK. This, I think, is something we're going to see more of in high value land locations. You look across the globe and places like Singapore, Tokyo, etc. For other examples, the valuation approach in the UK is typically that there's a 50% rent applied to the mezzanine floors, 50% of the ground floor rental level, albeit that these buildings are typically negotiated on an overall rent per square foot basis. So whilst we can't give you the exact number here, what I can tell you is that if you look at the break back, it's approximately £5.30 overall on the rent. and the ground floor rent devalued on the basis of a half rent on the upper floors works out to about £8.40 a foot, and the upper floor is about £4.20 a foot. Now, that's underwritten against our original target rental tones on a ground floor only basis across the site of 50 to 975, depending on the size of the building. And of course, here we have a very strong tenant with a very long lease. So we think that this is a great result for us. And of course, the other thing to note here is that the rent that we originally underwrote on this area of land on the site would have produced something in the order of around about £5.2 million per annum. And indeed, this building is delivering for us a rent of in excess of £12.2 million. So we've essentially doubled the level of rent we expected to achieve on this site. And in this one transaction, we've delivered the profit that we originally anticipated, and albeit we were very conservative across the whole site in this one deal.
Yeah. Okay. Just on a couple of points that you mentioned there. So about multi-level development. Obviously, that site in Littlebrook is a prime location. Would you ever consider traditional sort of multi-story as opposed to mezzanine development?
Look, I think there's been very few examples. I think it was it Seagrows X2? I think it was called Heathrow. Yeah. It was one of the earliest in the UK. I think we've talked to Seagrow about this, and they're pretty open about it. It was quite experimental at the time. I don't think it didn't do particularly well initially, but I think it's fine now. You may well see more of that. The question you have to ask yourself is what's the rationale with carving a building up horizontally as opposed to carving it up vertically and then utilising racking or the ability to move product down within the building. The issue with horizontal segregation is that the floors have to have a much higher loading capacity, closer to the ground floor level. So actually it only works for certain types of uses. So if you're a traditional user and you want to really rack a high level of loading on the ground floor level, you probably couldn't translate that into a mezzanine offer. And then the other thing you've got to remember is that accessing a building at multiple levels outside of the building envelope, i.e. with ramps, number one, takes up quite a bit of space on the site. So that makes the site relatively inefficient, but it's also expensive to build. And it's pretty expensive to maintain, and you've got noisy neighbour issues, which are far more relevant when someone's over the top of you than underneath you. So, and then finally, there are security-based issues as well that tenants express to us. So, I'm not expecting to see a real flurry of those. I think that they are better suited to, very, very high-value locations, such as Tokyo, by way of example, and locations such as that, where you're going up even higher. And we've seen in logistics buildings of up to 10 stories. In other parts of the world. So that could be something for the future. I don't think we're going to see a rush of those in the UK anytime soon. I mean, it'd be maybe more likely that you'll see that with what I would describe as a multi-use framework in major city centres, where you've got maybe retail combined with a bit of logistics, perhaps combined with some residential as well. Yeah,
that's interesting. Next one on your sort of development pipeline. Do you have plans to ramp up development given the high levels of demand and positive forecasts for demand going forward?
Yeah, so on this one, I think the first thing to say is when we acquired the Symmetry platform, we inherited 5 relatively small buildings that were in the course of speculative development. Mm-hmm. So we didn't want to put a foot brake on those. They were all subsequently completed. One of those has been let, and of the remaining 4, 3 are currently in solicitors' hands, and we have got discussions ongoing on the 4th actually. So we may well, following the letting of those, we may well embark upon a very small, controlled element of speculative development for smaller scale buildings in the right locations where the site configuration or topography means that we wouldn't necessarily be able to put on a larger scale logistics building, or if we feel that that's better suited to the to the demand in the local environment. But we're not going to get carried away with that, and we've always said right from the start that speculative development will always be a very small controlled component part of what we're doing. So the development platform is very much about being intelligent about the way that we approach it, with low cash drag, low cost of holding land and controlling land, mainly through option agreements, and primarily with a pre-let driven model to reduce risk. So that's the way you'll see us typically developing out the buildings. But of course, if there's strong tenant demand in the marketplace, and tenants know that there isn't the product available, they will typically wait. And the larger buildings do take a number of months in terms of planning, if they're going to be heavily automated as well. So that gives you the lead in time to be able to deliver a building in time with the occupier's requirements.
Cool. Yeah. And a follow-up on development. What percent of your portfolio do you think it will be sort of in the medium to long term?
Well, of course, it translates from one to the other. So, I think we are pretty comfortable with the level at the moment, 11% of GAV, 10-11%. You'll see us probably sitting around that level. It could dip a little bit lower than that. We don't really want to increase it beyond that level. We think it's important to keep around about 90% of our portfolio income producing in high quality investment assets. But of course, as we produce a pre-let and we develop out that building, that investment will then move on to the investment side of our portfolio. And that's essentially a way of renewing and reinvigorating and regenerating our investment portfolio, and allows us then to sell assets that are probably either we feel have maxed out in terms of performance, or perhaps don't closely fit with our strategic objectives.
Yeah, makes sense. Cool. We've got one here on automation, robotics and technology and things like that. What's the role of the impact of automation within the sector? And broadening the question, who is responsible for digitalization and technology within warehouses?
Yeah, so the answer to the last question is the occupier, the tenant. And whilst there is a sort of a broadly generic theming applied to automation, which I suppose in the easiest way of describing it is automated conveyor systems and automated picking systems, which fly up the face of a rack and pick the product, bring it down, put it onto a conveyor. Of course, it has moved on, and you've got other different types of systems now, such as Amazon's Kiva robotic system, where you have a robot that is like a rack that holds different types of products, and that moves to the picker, in sort of like a cage type environment. And then of course you can also look at systems such as Ocado's vertical integrated system, which is incredibly efficient. I mean, the building we own at Evert in London, next to the River Thames, that building is now, I think, about 3 years, two and a half years old. When it was finished, there was a building next door to it, which is the Tesco.com building, food picking building. And for every item that Tesco building picks, the Ocado building, our Ocado building, picks 4 items of food. So that gives you an idea of the increased level of efficiency. And it according to Ocado, is the most technologically advanced building of its type in the world in terms of food picking. It can pick up individual items of fruit without bruising them with suckers, etc. So I think there's an array of technology. I think you're going to see that continuing to advance with more and more robotics. What it does, of course, is it improves the potential for efficiency. I think that with automation, we've also seen an increase in stock control processes. Companies understand much better what they're holding. That comes from tagging and RFID tagging, really, as well as barcode tagging. And that's really important in understanding where their product is at any one moment in time, and also to ensure that you don't have, if you're someone like Ocado, and you're dealing with various different customer products, that there's not cross-contamination between those products. That's an important feature of their offer, by way of example. So all of that's put in by the tenants. We don't own that kit. because we think that that's a relatively high risk. We will own the generic component parts. However, it's really interesting because with an increase in automation, customers want, and they're investing a lot of money, sometimes hundreds of millions of pounds in these buildings, sometimes multiples of the investment value that we buy these investments for. And that's great news for us because it really cements them in. We call them sticky tenants in those circumstances. It really cements them to those locations, and they build their supply chain networks out from that nucleus, that breakdown point from the ports. But it's also that level of inward investment, of course, is encouraging them to sign longer and longer term leases. And that's a feature which we've seen in larger scale logistics in particular, which we haven't seen in other sectors of the commercial property marketplace. And I think with social distancing, if this is something we're going to have to deal with longer term, you're going to see more and more companies wanting to employ automation, because it creates, as Frankie was mentioning earlier, an inbuilt social distancing platform. As we've seen with Amazon and Ocado, they've been able to actually substantially increase their output, whereas other companies have been substantially affected and had to close as a consequence of COVID.
Yeah. And so what's been the impact and sort of the growth in this sophistication of technology on your sort of strategy on building specifications maybe, or locations and things like that?
Yeah, look, I think the answer to that's quite simple, really, Richard. We know quite a lot about that, but we're not absolute experts in that space, and it's a fast-moving area. So we leave that to the occupiers. You know, they have to decide what the best automated systems are for their type of product and how they run their supply chain networks. What we are ultimately providing is a very large, flexible space that is suitable to allow them to subdivide the building vertically, horizontally, however they wish, with the right floor loading. And if they've got a very, very large, flexible space, and remember that volume has really only become a feature of our market in the last 2 decades. There's utilization of volume. It's the economies of scale benefits and cost savings that they are gaining from utilization of that volume for the very reason that you mentioned earlier about, you know, half rate on. I mean, if you've got 4 operational floors of space in the building, ground floor plus 3 mezzanine floors, and you're paying a half rate on those mezzanine floors, that's fantastic business for you as an occupier, and that gives you an advantage over your competitive set. And it gives you perhaps the opportunity then to invest into that automation. So we think that what automation has done in some respects, and particularly these mezzanine floors, and by the way, this is a hangover. The 50% rentalisation of mezzanine floors is really a hangover. It's come over from the retail market, where retailers would complain that they had to encourage tenants upstairs and the footfall was lower, and therefore they couldn't pay as much rent. Well, of course, mezzanine, structural mezzanine logistics buildings such as ours, you don't have to drag a customer upstairs. You're an employer placing those employees up there, much in the same way as you do for an office building. You don't pay lower office rents as you go up the building in height, ignoring the fact you might have a view. So it's actually it doesn't make any sense. And I think over a period of time we'll see a much more of an equalisation in terms of rents. And therefore, I think what this has done is it's raised the glass ceiling of affordability for a lot of tenants in terms of what they can afford to pay us in the future, without really hitting the buffers in terms of affordability for the fundamentals of their business in terms of cost per unit of sale. And that's going to be crucial in terms of long-term rental growth potential in our space. And I think that gives us a lot of blue sky to aim for in terms of long-term rental growth. And that's what investors are currently seeing, which is one of the reasons why you're seeing a significant increase in demand for investments in the logistics space. And guess what? There aren't many to go around. So, there's going to be a lot more of these buildings created in the future. I think we're going to see increased investment demand. We could well see yield compression next year, partly as a consequence of the very low levels that 10-year gilts are sitting at right now, and the very high level of nearly 500 basis points positive yield gap that we've seen to the all risk property yield, which typically runs at the 250-300 bps level. So that's indicating that there could be further yield compression once the dust from COVID settles, and we're looking to that as a potential for 2021.
Cool. Just had a question come through here. How would you decide how much of an investor's portfolio to allocate to property relative to equities and bonds? REITs don't seem to be uncorrelated.
REITs don't seem to be uncorrelated.
Yeah.
Well, therein lies the $64,000 question, which I think has been sort of perplexing institutional investors and fund managers since the beginning of modern investment. I mean, direct property, as most people on this call will know, has typically comprised a small component part and has struggled to increase its positioning, partly because of although I think that investors typically believe they understand real assets and bricks and mortar, and therefore it should automatically scale up higher in terms of the component allocations. It has a fundamental issue, and that is one of liquidity, of course. I think that's one of the key things that REITs provide is provides a component, for liquidity. Now, of course, the REIT sector in the UK has been relatively small. If you compare it to the USA, by way of example, I think it's got a long way to go. It's getting there, and I think it would be great to see the UK REIT space grow further in the future, because it kills two birds with one stone to some degree. And I think it's a really important part of the overall equities market in the UK, and should be a bigger force. But of course, it's important always to make sure that any investor has a sensibly apportioned portfolio in terms of risk profiling, right the way through from cash to lower risk assets in terms of gilts, etc. And I'm not a financial advisor. I'm not here to advise people as to what levels that they should retain. And of course, those levels will change from time to time, subject to the risks that investors perceive in the marketplace. And COVID was a prime example where there was a significant flight to quality and flight to cash, and we saw that manifesting itself in gilt yields. So I think there's a time-related issue there, and looking at the backdrop of an economic component part. But if you have a high-quality proposition, as we believe we provide, in Tritax Big Box REIT, with really high-quality investments, with the best tenants in underpinning your income, with good transparency of income, with income growth potential, with the best quality real estate assets, then you're ticking a lot of boxes in terms of resilience, but you're also giving yourself the potential for growth. And we think that being able to offer that through an equity investment, where investors still have good liquidity, is a really attractive proposition. And that's why I haven't sold any of my shares in the 6.5 years since we've owned, since we started this company, Richard.
Yeah, cool. One last question. We had it earlier, but it'd be good to get your view on it as well. What do you think the impact an online tax would have on the logistics sector?
Yeah, that's a really good question. Look, I think there's been murmurings on this for some while now. At the end of the day, an online tax is going to be taxing retailers. Retailers, in one way, shape, or other, we're always paying taxes through rates on the high street, and whilst their rated obligations may be slightly lower in the logistics market because rents are lower in logistics, we're seeing a morphing taking place, really, a transition from largely high street sales to online. Now, we've never said, and we don't believe, that the high street will die. We think that the high street will continue to shrink, will become more of an experience and destination-based offering, and the same is true of major shopping centres. But it's important to remember that logistics was always there. It stood behind high street retail in the past. It's not an either-or. High street retail always had a warehousing platform that was supplying the shops. What's essentially happened now is that those warehouses are supplying the shops and other businesses and direct to the doorstep of the consumers, and that's the area that we believe will grow. And ultimately, tax has to be paid. The country has to be supported in terms of taxation, and it will be borne out by the activity in the economy in terms of sales, one way or the other, whichever sector it's in. And I think you'll see, you know, there's a very strong chance that we'll see something like that coming in. I think probably the market is generally braced for it, and I think that you'll see the majority of, if you look at overall sales, you know, the biggest increase in the component part of online, you know, the online market, Amazon aside, is those large scale, high quality retailers that are transitioning from the high street to online. So they're paying it one way or the other, and I don't think that's really going to change the overall impact of taxation to those companies and or to the economy more generally. I mean, there may be a bit of skewing, but it's not going to be profound.
What about the online only retailers?
Yeah, look, I think that they've had a strong run. I think that section of the market is very, very strong. I suspect that, yeah, the online only component will see some taxation to the extent that, you know, that they're paying a smaller component part of rates and other taxes. Then it's probably fair that they pay their share of rents. I mean, that's something for the government to work out. I don't think it's going to have a detrimental effect on demand for online. It's just another component part of costs that they will take into account. And I think what that will do is it will focus even more on efficiencies, on automation, on the ability to reduce, you know, the component cost elements of their operations. I mean, one's got to think more broadly outside of this as well, you know, in terms of you know, other savings that can be made in the logistics market. I mean, one's thinking ahead to autonomous vehicles by way of example. You know, one of the largest component costs in logistics right now is, you know, the costs of human drivers, and indeed, you know, the expectation that autonomous vehicles could give rise to increased, you know, traffic levels on our roads, and less congestion, because that could be, now perhaps some people say, well, that's a long way off. You know, I think we've typically underestimated the speed at which technology is going to affect our lives. So it might come sooner rather than later. And of course, in the meantime, we've also got to look to EV and how we're going to deal with an increased level of electric vehicle use on the roads. How we're going to power all those vehicles. That's something we're looking very, very closely at on the Symmetry platform. We're targeting the carbon net zero buildings now and putting a lot more charging points in our buildings, and that's going to be delivered largely by PVs on the roofs. And of course, you know, what better place to be able to put solar panels than on the largest buildings in the country, which are typically these logistics buildings. So I think we've got a really important part to play in terms of sustainability in this market, as a consequence of those initiatives as well.
Cool. Okay. All right. That's the. I'll just have a quick look, but I don't think there's any more questions. No. So we'll wrap it up there. Thanks a lot, Colin and Frankie, for your time.
It's a pleasure, and thank you for hosting, and thanks everyone for joining us on the call today. We really appreciate your time and your interest.
Cool.
Bye-bye.
Have a good day. Bye.